Good morning, everyone. Welcome to today's online academic event on banking resolution in COVID-19 times, jointly organized by the European University Institute's Florence School of Banking and Finance and by the Single Resolution Board. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance, and I will be your host for this very intense morning. As many of you will know, banking resolution is close to the heart of the FBF, at least since 2017, when we launched our first autumn school on banking resolution, a course that we actually just held in its online version earlier in November. Several of today's speakers were actually a part of it. Today's event aims at being an opportunity to engage with new analysis and ideas on banking resolution in the current context, and I want to say that we're very pleased that around 1,000 participants registered to our joint event. Before we start, I'd like to thank very warmly the Single Resolution Board for the wonderful and close collaboration and engagement. Special thanks go to Suzanne, Camille, Sean, Sami, and Nicola. It's been a real pleasure to work together during the past months to make today a successful and insightful event for all registered participants. I'd like also to thank my colleagues, Maria, Jan, and Laura, for all their work in preparing today's event. With no further ado, let me hand over to Professor Barthuizen, who will introduce today's event. Professor Barthuizen is a professor of financial supervision at the Vrije Universiteit of Amsterdam and a lawyer in private practice, Recofis. His expertise includes bank resolution and securitization, and he's collaborating with our school in both fields. Bart, the floor is yours.
Thank you, Pierre. Ladies and gentlemen, we are in exceptional period of our existence. The pandemic outbreak has major consequences for all of us. Our lives have been turned upside down. Today, the event takes place via an online platform where the organizers, the Single Resolution Board, and the Florence School of Banking and Finance would, of course, have preferred to make it a live event. But this is the price we have to pay for our health, and it is a price we can afford for it. We'll get out of here. Shortly after the outbreak of the pandemic, it became clear that the restrictive measures would have an extreme impact on the world's economies, including Europe. The consequences for the real economy have been mitigated in the first instance by generous government interventions that have come to the aid of individuals and companies with short-term solutions. The banking sector was also promised relaxation of prudential rules by the competent authorities, but this was a strategy whereby banks were not so much part of the crisis, but had to be part of the solution. Banks have taken up that gauntlet, and there has been a substantial contribution to consumer and business financing, helping to bridge those trapped by the pandemic. However, banks have taken generous provisions, particularly in the first wave of restrictive measures, by granting deferment of payment, often for shorter periods, and on a more specific scale, also providing bridging financing. At the same time, the EBA, ECB, and the national competent authorities urge banks to exercise extreme vigilance regarding the development of problems in credit portfolios. Much of the good work that has been done to bring non-performing exposures down to lower levels is expected to wind down on a fresh rise in those NPEs in the coming period. The fundamental question is therefore whether banks will be sufficiently resilient to absorb these new blows, or whether a new period will be drawn in which banks will get into difficulties. The question therefore concerns to the extent to which the resolution framework it was just in the final phase of renovation as a result of BRRD2 and SRM2 rules will be subjected to the ultimate test and must be put into practice. Policy debate and academic writers have therefore recently focused on the question of whether the existing resolution framework should be revised to address the very specific problem of the pandemic. For example, is there a need for a review of precautionary capitalization rules to help banks that, though no fault of their own, are in danger of failing as a result of exogenic circumstances? These and many other questions are currently at issue and will undoubtedly be addressed in today's debates. This seminar was organized after a call for papers in July 2020. The organizing committee has received many contributions of high quality from a diversified group of disciplines: economics, political science, and law. Unfortunately, a selection had to be made, partly because of the organization of this seminar in an online variant. If there has been a physical event, more of the submitted contributions could have been covered. Anyone who has made the effort to submit papers is expressly thanked, and we are confident that any input will find its way in the further developments of debate, even after this morning's exchanges. I would like to expressly wish all the participants in the debate a lot of inspiration, and we look forward to an interesting, albeit intensive, morning. I would like now to give the floor to Sebastiano, who will be introducing the first speakers of the START panel. Thank you very much.
Thank you very much, Bart. We will indeed now move to the first session of today, chaired by Sebastiano Laviola, who I see joined us. I don't see him yet on video. Mr. Laviola joined the SRB in 2019, and he's currently a board member, director of strategy and policy coordination. Before that, Sebastiano Laviola was a central director at Banca d'Italia for a few decades and also worked at the Italian Perm Rep in Brussels as a financial services attaché. Before we start this first session, let me just make a note of housekeeping to stress that questions by participants should absolutely be written in the Q&A box of Zoom, not in the chat box, because the Q&A box is where the debate and the discussion will be. The comments in the chat box will be ignored. Mr. Laviola, the floor is yours. So at this stage, we don't hear or see you. Let me suggest that we move on to the presentation of the paper by Christos Goratsos, Michele Siri, and Marco Bodellini. So there will be 15 minutes for the presentation of the paper, followed by 10 minutes of discussion by Emiliano Tornese, and then we'll have a Q&A. So with no further ado, we will now... Okay, I see you now. Mr. Laviola, if you'd like to say a few words before the session starts. Okay, let's move on then. Christos, Michele, Marco, the floor is yours. Christos, we can't hear you. You're on mute.
I'm terribly sorry.
Now we do.
Yeah.
Fantastic.
I'm terribly sorry.
Christos, can you see the slides on the screen?
I can see. Thank you very much. Good morning. It is with great pleasure that we participate in this event. And as I understand, the competition for papers and the selection was high. So this makes us twice happy and honored to have been selected in this event, our paper, which we have conducted together with Michele Siri and Marco Bodellini on a topic which we consider to be of quite significant importance. Following the words that have been said by Bart before, it is obvious that banks in the current situation are in a much better position than they were in previous crises, both the international, the global financial crisis, and the crisis in the Eurozone. And this is mainly due to the fact that the Basel rules, the Basel III framework as we know it, as implemented in the European Union, at least, but all over the world as well, has made banks more robust in terms of both capital adequacy, quality of capital, and at the same time, liquidity ratios. On top of that, as a result of that crisis, we now have also robust resolution frameworks, which were not there at the beginning or during and in the very aftermath of the global financial crisis and the beginning of the Eurozone crisis as well. So on the basis of the existing legal framework and waiting for some further revision of this framework, because we all know that we are in the middle of a crisis, currently the pandemic crisis, an exogenous crisis for the banking system, but still heavily affecting it, as we can see and we know. The framework will change again because by next year we'll have the implementation of new rules on the MREL and the TLAC. And on top of that, in 2 years from now, we'll have the implementation of the new rules on the finalization of the Basel III, even though there was a postponement. So overall, the banking system is currently faced with the following situation. On the one hand, it is definitely more well capitalized, this is given, on average and across the board, facing though challenges with regard to new requirements which are coming up. On the other hand, it is required, since it is part of the solution of the problem and not part of the problem, to contribute to the financing of the real sector of the economy. And according to the data that we already have available, published by the ECB and the EBA, it looks like the demand for loans has been increased, and at the same time, banks have, with a variation throughout the quarters, responded to this demand. Nevertheless, there is an inherent problem which has not yet shown at its whole extent, and this is the problem of the NPLs. And given we have the first evidence by the EBA on the use of the moratoria and the public guarantees in the banking sector, and we know that the use of these moratoria and the public guarantees has been huge. So the problem remains for the next year when this moratoria will expire, and it is expected, not from us only as the conductors of this paper, but across the board, that the number of the NPLs will increase. And the question which arises in this case is whether the existing capital adequacy of banks will be sufficient to absorb the losses which will result from this increased level of NPLs. So our paper is a proposal to add to the various tools that might be used in order to allow for banks to be recapitalized and to become a part of the solution of the problems which will appear with the increase of the NPLs in the coming months. We are not expecting that this solution, even if it were to be adopted, would be the only one which would be available, and definitely not the only one which would be appropriate. You need a blend of measures. You need an increase in the quality of risk management by banks. You need a higher level of vigilance by supervisory authorities, making use of their supervisory powers according to the existing regulatory framework. you will need some kind of resort to asset management companies and asset guarantee schemes. They are already in place in several countries. Securitization can also play a role, but on top of that, it may be the case that the existing framework on the precautionary recapitalization embedded in the resolution framework could be enhanced. And our proposal, as will be developed just after me by Marco Bodellini, the 7 pillars of our proposal will be presented, is based on the assumption, point number 1, that there will be no compromise at all in the implementation of the resolution framework. We are not dealing with any kind of compromises with regard to resolution planning. This has to be taken into account. It is, as I said before, one of several measures that can be used. It's not the only one. It is also noteworthy that our proposal is based on an amendment of the SRMR and not of the BRRD. And this is due to the fact that even though we know that this might create some problems with regard to the internal market, we precisely make the ESM part of the solution of the problem. And this could be definitively only for the Eurozone. So within this context, we have conducted this brief study in the expectation that with an amendment, a temporary amendment of the framework governing the precautionary capitalization, only for the duration of the pandemic crisis, and mainly for the banks which have been affected negatively by the pandemic crisis, the regulatory framework could be enhanced by an enhanced instrument which already is embedded in the system. I stop it here and I give the floor to Marco.
Thank you, Christos. Marco, you have about seven minutes and a half. Thank you.
Thank you, Christos. Thank you to the Single Resolution Board and to the European University Institute for having us here today. It's a great pleasure to be able to present this paper in front of such a distinguished audience. So I think Christos pretty much introduced the underlying idea on which our proposal is based. Let me now try to develop on the details of this proposal. As Christos said, the idea would be to introduce a temporary amendment of some of the rules on precautionary capitalization, which are included in the Single Resolution Mechanism regulation, to allow, let's say, widespread application of this tool on the assumption that at some point when moratoria and the other relief measures will be lifted, possibly banks will face a significant issue in terms of non-performing loans. To make precautionary capitalization available on a larger scale, we analyzed the conditions which are actually currently required within the framework, and we came up with the idea to change 3 of the 7 conditions which are currently requested. Let me start with the conditions that we don't think need to be changed because we think that in the current context they are already met. The first one being that precautionary capitalization should be used when there is a need to avoid or remedy a serious disturbance of the economy and preserve financial stability. We don't think that this condition needs to be changed because it can be met in the current situation where the entire economy will be facing, actually is already facing a serious recession, and these at some point will also be transmitted to the banking sector, as Christos said before, in terms of an increase of non-performing non-performing loans. The second condition, which is currently requested by the legal framework in place, is that the measure is currently available only for solvent institutions and institutions which are not determined as failing or likely to fail. And I will come back to these in a minute. The third condition is that the measure should be of a precautionary and temporary nature. We don't think that there is a significant issue in terms of the precautionary nature of the measure, because we conceive this tool as an instrument to use to prevent banks from becoming insolvent and failing or likely to fail as a consequence of the impact of the crisis provoked by the pandemic. Whilst we might face some issues in terms of the temporary nature of the measure, which is connected with the exit strategy that we need to put in place to allow the European Stability Mechanism, which in our view is the supranational player which should be involved to recapitalize banks in need, to easily exit from the equity investment. And again, I will come back to this in a minute. The intervention must be approved by the Commission, and again, we don't see any issue with this, even more so with regard to the position recently taken by the Commission in terms of facilitating the use of public money to rescue struggling enterprises, not just in the banking and the financial sector, to face the consequences arising from the current crisis. The measure should be proportionate to remedy the consequence of a serious disturbance, and again, no issue at all. And then the measure should not be used to offset losses that the institution has incurred or is likely to incur. And again, this condition probably needs to be amended, and we will tell you how in a minute. And then the seventh condition, which is the fact that the capital increase should be limited to injections which result from stress tests. And again, this is an issue because the EBA has determined that there will not be stress tests until 2021. The first condition that in our view should be amended is the fact that the measure is reserved for solvent and non-failing or likely to fail institutions. And again, as a consequence of a significant increase on non-performing loans, likely many banks, or at least a significant number of banks in the forthcoming future, might become failing or likely to fail and potentially insolvent. Again, to face this issue, what we propose is the introduction of a timeline which could be aligned to the pandemic declaration in March 2020 or sometime afterward. And we argue that credit institutions whose liabilities have exceeded the assets as a consequence of the requalification of the assets as non-performing loans subsequently to the pandemic declaration, and as a consequence of the pandemic, should keep on being considered solvent and not likely to fail, only for, of course, for the purposes of the application of this tool. A similar mechanism is envisaged with regard to the likely future losses requirement, in the sense that once again we envisage that losses arising from loans which have been requalified as non-performing loans as a consequence of the pandemic, in connection with defaults which have taken place after the pandemic declaration, could be not considered as likely future losses for the purpose of the application of this tool. With regard to the last condition which should be amended, the fact that stress tests will not be available until 2021, we just argue that a similar tool, let's say applied on a case-by-case basis, could be developed by the supervisory authorities to determine the amount of capital that banks will need at some point. And again, in substantial terms, what we envisage is the involvement of the European Stability Mechanism, also moving from the consideration that many member states do not want to ask for the pandemic credit line because this is considered risky in terms of market reactions. So the European Stability Mechanism has a significant amount of resources quickly available. What we argue is that the European Stability Mechanism could issue senior bonds on the market, market, and then it can use these resources to buy either, for example, CoCos issued by banks which need to be recapitalized. And then in order to facilitate the exit strategy, these CoCos could be either converted into shares to be given to the bondholders, private players, private investors, or the possibility to issue new bonds when the previous ones expire. A few final considerations. We think that this proposal is very much aligned, as I was saying before, with the position taken by the European Commission with the temporary framework. We also think that, as Christos said at the beginning, this shouldn't be seen as a substitute for the resolution framework, which of course should stay in place. But we also think that in the current situation, a widespread application of the bail-in tool might be potentially counterproductive. So the idea is to have one more tool at the disposal of the authorities to be applied in the case in which this is considered to be potentially more effective than others. And I will stop here, and then we can keep on discussing on the basis of what Emiliano wants to say and on the questions.
Thank you.
Thank you.
Thank you very much, Marco.
Hello. Do you hear me?
Sebastiano, I can see that you hear us, so I will be
Yes.
happily
Do you hear me?
handing over to you.
Okay, so good morning, everybody. Sorry for the delay. I had problems in connecting myself, but now I would like to give the floor to Emiliano Tornese for 10 minutes as a discussant. Emiliano is deputy head of the unit of the FISMA in charge of bank resolution. So, I mean, I think he's one of the experts today to start the discussion, the commenting this paper, and then we will have a session of Q&A. Thank you.
Thank you, Sebastiano. Thank you, the SRM, for inviting me. I mean, first of all, a small disclaimer. Of course, all the views that I express do not represent the position of the Commission or the Commission services. And I would like to also to play the role a little bit of the devil's advocate. So I will comment and challenge slightly the article itself without proposing solutions, also because that in our audience we have a lot of experts also from the market side who are certainly more expert than me in providing solution to this kind of problem. And I would like to start mainly on two points. So the proposal is focused on and centered on two main elements. First of all, it suggests an amendment to the single resolution mechanism, and it provides a role for the ESM. So these are the two core elements. But I mean, starting assessing the article itself, it's good that the article recognizes the achievement of the financial crisis regulatory reform. So today, banks have more capital and the asset quality have on average constantly improved. So I have to say the legislator got it right. And we must have faith in the legislator, which is very important also to assess also the necessity or not to amend the current legislation. And this is also the reason why today banks are not the problem, but they are part of the solution. The article, rightly so, mentioned the fact that there are two schools of thought. First of all, there are those who think that banks have capital enough and therefore should be able to distribute dividends or buy back their own shares. And there is also the other school of thought saying, actually, indeed, a big wave of NPLs are coming. We still don't know what is this situation. So probably the banks should not distribute dividends and buy back their shares. I mentioned that because, of course, and we had a long preparatory session also with Christos, Marco, and Michele. You know, the first comment I made is that this solution cannot be the one you propose as the only solution. And I'm very happy that, in fact, a lot of emphasis has been put on the fact that we have to look also at the risk management of the bank itself, the supervisory measures, and also other measures. Therefore, it's true that as several supervisor and resolution authorities have mentioned, relevant amount of NPLs as a consequence of the crisis might be common, We don't know what is the distribution and the amount of the problem, but the article doesn't praise enough what are the positive effects of the measures which have been adopted by member states, think about guarantees, or the legislator itself in terms of the banking quick fix, for example, which has been quickly adopted, and also the measures adopted by the Commission. So we have to see a little bit also what is the impact, or if they can be a continuation of them. So going back to the fact that the article has the objective to strike a balance, not between financial stability on one side and also the interest to discourage the excessive moral hazard, the article seems to rush too easily in a way and too quickly into a one-size-fits-all solution, which is first of all politically challenging, as I also see in some of the comments and questions in the chat. As I said, doesn't take or doesn't seem to take in consideration too much the specific circumstances of each banks, and also the current and existing flexibility which is embedded in the legal and the supervisory framework. Indeed, the article mentions some, but doesn't explore all possible complementary instruments or options, in particular within the bank, which could be used and should be used well before the introduction of such an ambitious solution. As I said, member states could extend their measures. I'm not, of course, talking to them for them, but this is an element which has to be factored in. The existing flexibility embedded into the regulatory framework, or additional flexibility which could be introduced by the legislator to allow the banks to deal with the problem from within. And I recall how the banking quick fix was adopted in a record time. So to praise again the legislator, I have to say the article proposed an interesting idea on the timeline approach, not to distinguish between legacy NPLs from COVID NPLs, and again stress a lot the importance of alternative and complementary instruments like asset protection schemes or asset management schemes, be it national AMCs, network, or European. Moreover, while the article claims to address potential dangers for economic and financial stability, and this is also one of the topics raised in the chat, it limits the scope of the new instruments only to SSM and SRB banks only. So what about others? Would they go into resolution, liquidation? And what about the internal dimension, internal market dimension? The proposed solution seems indeed to address the issue of the level playing field in relation to the different fiscal capacity of the member states within the euro area, but what about the non-euro area banks? So this is a relevant topic to consider. Moreover, there is the assumption that the markets and investors will not be able to inject equity into the banking system. Therefore, the market seems to be replaced by the ESM. But is the proposed solution, which may end up with a possible, and I'm a little bit provocative here, European nationalization of the euro area banking system, able to ensure an easy and quick exit strategy? Or is it another way to postpone the potential problem? What about a market more or private transaction solution, which are more based on some sort of support, thinking about loan or guarantees, as this was devised also during the financial crisis? Of course, all these subject to the scrutiny of state aid control and so on, but this is not the focus of the article. Is the solution providing the right incentive framework? That's also the question. Moreover, the article seems to suggest that such a temporary, revised and standardized form of privately and publicly funded precautionary capitalization is always to be preferred to a credit institution liquidation financed through public resources. And this is just a question. Is it always true, in particular in the context of an overbank system? Moreover, if the legislative change were necessary, as the article suggests, why only temporary? The article mentioned the general escape clause of the Stability and Growth Pact. Can there be other pandemic? So can we have, again, the need of such a kind of escape clause? Of course, the assumption should be that the legislator has already provided all the necessary instruments and flexibility under the government stabilization tool and the precautionary capitalization. which are the systemic and financial stability clause. In addition, while the key word for any crisis management framework is flexibility of the tools, powers, and solution, to what extent such an ambitious solution can be standardized and become quasi-automatic? I go back to the argument, are we setting the right incentive framework? Moreover, the article refers to privately and publicly funded precautionary capitalization. Why it looks like mainly as a publicly funded, because at the end of the day, it would be the private buying the ESM bonds and so on. What about COCOs who are guaranteed instead and could become therefore an alternative instead of having the ESM issuing bonds, senior bonds, and use the proceeds to buy bonds? And two final points, the proposal foresee a role for the ESM in monitoring than the bank. Is there any risk of overlap with supervisory functions and resolution functions of the existing authorities? And the final point is, it's still not clear how this ambitious solution would facilitate market-driven cross-border consolidation. And I will stop here.
Thank you, Emiliano. I think we should now, I would read out some questions that have been formulated in the chat box. As I understand from the organizers, this was the tool to be used. And I would group some of the questions so that the two speakers can address both Emiliano's comments and some of the questions. So I would start from one, which is from Borea Pelletero, that essentially says that the failure of one small credit institution could also undermine the confidence of customers and endanger financial stability. So the question is, do you think that this or another solution with the same objective could be implemented to avoid the failure of small banks which were solvent at the beginning of the pandemic? Then some more institutional questions. And the first one is from Nicoletta Masker from the ESM, whom I take the opportunity to wish. And here she correctly, I believe, raises some issue regarding the institutional goals of the ESM. So without recalling them, essentially the question is if the authors have considered the changes needed in the ESM treaty to make the proposal viable. This also is an interesting question. Then there are questions regarding the tools that are used, the instruments, so why COCOs and not equities. There are other questions of the same type that consider that there could be a circularity between issuing COCOs and then the proceeds of that would be loaned to banks again, and the tier 2 banks would be made of these COCOs. Then there are a set of other questions which essentially say why instead of essentially find, although it is a temporary framework that is proposed to recapitalize bank with public money, why not enhance? This is a little bit in the same vein of what Emiliano was saying. Why not enhance the crisis management framework that we have now? So to conclude it with EDIS, with the ESM backstop, introduce the general depositor preference rather than the super depositor preference, and then so on and so forth. And finally, I would also myself, there are also other questions on the ESM, all more or less on the institutional side, on the type of instruments. I think all the colleagues connected can look at the chat box. And finally, from my side, I would also add that the two more important aspects where you would need amendment in this framework with regard to the state aid proposed state aid framework is essentially what to consider as a baseline or adverse scenario to justify the injection of public money. So what counts as expected or future nearly likely losses. And then the timing of that, because it is true that one could take this date of the declaration of the pandemic, but nevertheless, the NPL have not yet, come out massively. We know that they will surface in the future, in the next 1-2 years. So there is also a question of mismatch of timelines, which should be overcome one way or another to make the proposal, fully in line with the framework. I would stop here, and I would give the floor to Christos and to Marco.
Christos, you're muted.
Christos, we can't hear you.
You're still muted.
You unmuted me, yeah. I see my watch, and I think we have 2 minutes to answer to all these questions.
Let's go until 10:05.
Yeah.
So we have 8 minutes left. There are other papers to go through today. Thank you.
Yeah, it's mission impossible even in 7 minutes, but I can take 3 minutes of the 7 and give some initial reaction to what has been commented. And then potentially, if this would be okay with you, Pierre, we can collect the questions and send you by next week complete answers to all these questions, yeah, which might lead potentially to an enrichment of our paper. Let me start with one aspect that Emiliano raised. Emiliano, if the day would come that the Commission would fully accept this proposal, I would be very happy to drop the temporary. Yeah, so the temporary has been inserted as a kind of a hint that we do not wish to unwind the resolution framework. And if this is a correct signal, then okay, yeah. But if you think that this kind of, if one would consider that this amendment could last for a longer period of time, at least for me, that would be okay. Coming now to the very crucial remark, and I know that this is very important, whether small banks could be covered. Yeah. We fully understand, and we have discussed it before. But again, if you need a backstop from the ESM, given all the necessary changes that have to be implemented in the ESM framework as well, yeah, then you would not have the possibility to do it for the entire internal market. This is a first reaction. But again, one can think of alternative means in order to enhance this. Coming now to one of the questions that I have heard about the ESM, I have read in the Q&A the question. You mentioned the DRI, yeah? The direct recapitalization instrument, of course, is already in place. But if I'm not wrong, it has never been used since 2014 when it was established. And I think that the conditions for the implementation of the DRI, for making use of the DRI, for the operationalization of the DRI, are much stricter than those of the precautionary capitalization. But we can go one by one and make the check. By the way, we could not expand on all the aspects, especially comparing as correctly, you mentioned, Emiliano, with the alternative means, because one of the requirements for the competition was that the paper should be limited to 10,000 words. So we did not intend to write a monography here, but it may be the case that we will need to extend it. And then when you spoke about the nationalization, Personally, I'm not very much in favor of public state of any kind of state aid, but potentially in this crisis, and if the worst case scenario were to materialize, meaning that especially in certain member states, the amount of NPLs due to the crisis, not the legacy NPLs, due to the crisis might increase, it might be the case that it would be more realistic to make more use of the precautionary capitalization in its existing form or in any other form, instead of having banks being liquidated. And I don't even touch upon the political dimension of this. I stop it here, and Pierre, if we can answer to each and every question, I would be very much willing to do so. Yeah, I think the whole group could do so. Yeah.
Shall I add a few more comments? So thank you for all the comments and the questions. They are all very, very, very interesting. I will try to react to some of them. So someone asked about why don't we think about an enhancement of the crisis management regime. I think this was kind of tackled in the sense that we don't push for, let's say, the disapplication of the resolution framework or the crisis management regime. What we intended to do was just to advance and to improve and to make available this tool on a larger scale, to be put at the disposal of the authorities, along with all the other instruments which are already in place. And of course, we also mentioned asset management companies to manage with a longer term view huge portfolios of non-performing loans. That's of course a potentially useful instrument to be developed. About the timeline, yeah, probably. I mean, the idea was just to introduce a mechanism. The mechanism could be refined. I think that the timeline could also be postponed. But the idea was to start discussing about finding a mechanism to distinguish the problems which already were there, and the problems which have been caused by the pandemic. And the idea is to tackle these two different types of issues with different tools. Why COCOs and not shares? Again, we think that with COCOs, the exit strategy for the European Stability Mechanism could be easier than just by buying shares. We don't push for a nationalization of the euro area banking system, but the idea is to have a solution ready in the case in which market players, private participants are not willing to buy shares of banks because they just don't want to invest in equity, or they've been affected by the crisis and they don't have the resources to invest. So with the involvement of the European Stability Mechanism, we think that potentially also private investors might be, let's say, facilitated in doing the same. Again, the involvement of the European Stability Mechanism could be the answer to avoid different reactions in different member states having different fiscal capacity. Of course, there are member states which potentially have the resources to recapitalize the domestic banks, while others are not in the same situation, and this could be potentially detrimental for the survival of the banking union. I think I'll stop here, and thank you.
May I add one word? If you allow me, very briefly, I have seen just in the chat one question concerning the appropriateness of the banking communication from Alex Lehmann from Bruegel. My answer would be no, the banking communication of 2013 has to be updated. Yeah, so this is one of the pillars of the revised framework that we need to consider.
Thank you, Christos. And I think that unfortunately time is very short, so I think that we have to move and go to the next paper, which is going to be presented by Irene McCarthy, who is adjunct professor of business and European banking law at the University of Siena. And she will introduce her paper, which is called Deposit Guarantee Schemes in Bank Crisis Management, Legal Challenges Arising from the Actual EU Legal Framework. The discussant is Seraina Grunwald, Professor of European and Comparative Financial Law at the Radboud University, Nijmegen. So, Irene, the floor is yours.
Yes, do you see me?
Yes.
Yes, but I don't find the slides. Let me check the situation. It's here. Okay, presentation. Sorry. Okay, so here, screen share, presentation, and usually it's. Yes, it's okay now?
Yeah.
Yeah, okay. Good morning to everyone. And it's a big pleasure for me to be here. Yes, for sure, it would have been nicer to be in Brussels, but I mean, we do whatever it takes according to the sanitary condition. Now, if someone reads my paper, we'll see that some of the paragraph titles are inspired by a song of the English band, the Coldplay. The song is The Scientist. I made this choice not because I believe that there's something of sentimental or regarding the deposit guarantee schemes, but because of the text of this song. This song talks about a scientist that is obsessed with science and progress. He neglects the love of his life, and when he repents, it's too late. So what is the connection with our really less sentimental topic? The connection is that the pandemic, for sure, has emphasized this kind of feelings in all of us, sadness and pain, and also neglect. So as regards to the banking crisis framework, I made this connection in the sense that I thought that the banking crisis framework works, but I mean, there are a lot of legal problems, a lot of issues, a lot of challenges that have to be faced. So the COVID-19 crisis could be the good occasion to address these challenges and to overcome them. In the first panel, I mean, they talk about the role of the banks in keeping the real economy afloat, so I'm not going to go on this point, but I would like to underline that the COVID-19 crisis, which is a human and health and an economic crisis for sure, might be also a banking crisis. So banks are expected to face further losses in the near future. And in this context, it's very important that banks remain resolvable. But as we know, resolution is for the few, is not for the many. Then a lot of banks, and I refer both to less significant institutions, but also to significant institutions not subject to resolution, will be liquidated under the not yet harmonized applicable national law. So in this context, the role of DGS, according to me, is very important because they can prevent the bank insolvency. So let's see very fast, I mean, what is the role that the DGS play in the financial safety net? They work in three ways. First of all, they reimburse the depositors. So the main function is the deposit payout. Then they can avoid the bank's disorderly liquidation through a variety of measures like capital support, guarantees, and then they support the transfer of assets and liability to a buyer of the bank business. This kind of these three functions are replicated and enlarged in the Deposit Guarantee Schemes Directive, where we can find the compulsory measures that are like deposit payout and liquidation plus the financing of resolution. which implies functional payouts, then we have what I call preventive measures and alternative measures. The first are applied to avoid liquidation, so before the liquidation and outside the resolution. The second are applied within the liquidation procedure. Both of them are kept, financial kept, to the respect of the least cost criterion that we are going to see. And for this kind of two measures, it's up to member states to implement them inside the national legislation. So they are not compulsory also under this point of view, and not all the member states implemented this opportunity for the DGS. So despite the wide mandate that the directive states regarding the DGS, they have to go beyond a pure reimbursement function and use the available financial means in order to prevent the failure of a credit institution. Despite this broad mandate, in reality, there are a lot of legal constraints that arise from the current regime. And I refer to the BRRID, to the Deposit Guarantee Scheme Directive, and to the Banking Communication 2013. And I mean, you know what I mean, it's interpretation made by the European Commission. I divided these constraints into blocks. On one side, I will analyze very fast, quickly, the state aid rules problems, which affect in turn 2 points, mainly the status and the governance structure of DGS. And on the other side, the DGS intervention and the FOLF assessment. The last point of my presentation will rely on the super priority rule coupled with the least cost criterion and the legal constraints that arise from this dangerous combo. So let's see the stated problems. I clearly refer to the Tercas case and its annulment by the General Court. 1 month ago, also the Advocate General Tanker released his opinion that mainly confirmed the position of the General Court. According to the European Commission, the DGS intervention other than payouts, so I am focusing on preventive intervention constitute and state aid when two conditions are met. The state has the power to control the DGS and or to exercise a dominant influence over its decision and operations, is the so-called requirement of the imputability to the state. So the organizational and decision-making independence of a DGS, never deemed relevant by the EU law since nowadays are a condition for using preventive measures. So all the DGS in Europe that have a public governance or, for example, are incorporated within the resolution authority will have to change their legal status and their governance if they want to skip the problem of state aid according to this point. The other point that is the question of the public resources. According to the European Commission, the deposit guarantee scheme resources are deemed to be public because there's a compulsory membership of the banking institution and because the contributions are mandatory and determined by law up to a predetermined level, despite the fact that the DGS is private and financed by its member. It's private because the Tercas case, as you know, relates to the Italian Fondo Interbancario di Tutela dei Depositi, which is a private entity. Now, this point, I think that it's crucial, has to be revised by the European Court of Justice because neither the General Court focused really well on this point. According to me, there's not this condition in the sense that normally, according to the European Court of Justice case law, we have public resources, although the entity is private, when the entity is established by the member states in order to help an enterprise in a manner that helping this enterprise, the others are in a worse position. So selective manner. In this case, the DGS are not imposed by member states, they are imposed by the EU law, and also the compulsory membership and the compulsory contributions are imposed by the EU law. So there's not ground, according to me, to apply the public resources requirement. Now, another legal constraint or problem that arises from the position of the European Commission is the connection with the condition of resolution. What I mean? I mean that if the use of DGS funds for failure prevention are considered as state aid, then there is an extraordinary public financial support. Then a condition of resolution is met. Paradoxically, a bank that maybe could be brought to a going concern is face itself in a situation that, because of even also the proposal to intervene by a DGS, has to be either put subject to resolution or liquidated. Then, let's go to my last point, which is the problem of the constraints resulting from the least cost principle and the super priority rule. DGS have to respect the least cost principle, which is different if they undertake preventive measures or alternative measures. Generally, they have, in any case, to make a comparison between the cost of the preventive measures and the cost that they would suffer within the liquidation procedure, net of the recoveries within the liquidation procedure. Now, insured depositors are preferred within the liquidation procedure to any of the bank's other unsecured creditors in the creditor insolvency hierarchy. Then, if insured depositors are reimbursed, the DGS subrogates to the right of the insured depositor against the liquidation with the same super senior status. What happens? We have two effects. One effect on liquidation, but also resolution. In liquidation, it is widely accepted that the combination of the above rules significantly hinders the implementation of alternative measures by a DGS. Why? Because of the potential high recovery rate in the bank liquidation. But it also affects the contribution to resolution, as according to the BRID, the liability of the deposit guarantee scheme shall not be greater than the amount of losses that it would have had to bear had the institution being wound up under a normal insolvency procedure, which is the application of the no creditor worse off principles to the intervention of deposit guarantee schemes. How to assess these legal constraints? In my paper, I report three proposals. The first one has been proposed by Fernando Restoy in a paper that released this summer, but not only by him, but I mean, it's a very good paper on this point. And the first proposal is to replace the current super priority of covered deposit with a general depositor preference. Covered and not covered deposit rank senior to other liabilities, but pari passu with each other. Now, this proposal is very straightforward. I heard that it has been recalled also before, and I think that we have to go in this direction, but it could be useless when the DGS will have to finance the sale of business of banks with large amounts of uncovered deposits. Why? Because when the sale of business is the strategy, the buyer will buy also the covered and not covered depositors. So the wider will be the liabilities, the broader will be the finance that will be required by a DGS. So we have another solution that is inspired by the US regime, is to increase the deposit insurance threshold from 100,000 euros to 200,000 euros. Cannot add a lot about this proposal. The EBA stated that we don't have to go to this direction. In reality, every time that we talk about increasing the level of coverage, we have also to consider all the moral hazard issues that come from this kind of choice. The third proposal, which is mine, not because I'm a genius, but because I have been inspired by the Italian system, is to relax the method of assessment of the least cost criterion, considering not only the direct cost, but also the indirect costs. This proposal has a legal base in the Deposit Guarantee Scheme Directive, where it's written that the deposit guarantee schemes has to consider also the adverse impacts of the liquidation. With adverse impacts, the directive relates to the cost of the failure of a credit institution to the economy as a whole and its adverse impact on financial stability and the confidence of depositors. It's very generic, but I believe that we have to stay in, we cannot list all the indirect costs, because it's important that the Resolution Authority and the DGS will operate in the case-by-case situation, because every bank is different. Now, I go to my concluding remarks. I believe that a rigorous application of the stated discipline does not seem appropriate in the case of use of DGS funds, because it prevents them from fulfilling their traditional function of preventing and managing bank insolvency. Then there's a need of amendment of the Banking Communication 2013, at least differentiating among DGS with public and private legal status and or governance structures. Then it is desirable for the ECJ to reform both the EC and the General Court decision, stating that no state aid is granted when the resources come from private banks due to obligation imposed by the EU law and not by the member states. As regards the BID, it's necessary to distinguish between extraordinary public financial support and use of DGS funds, clarifying that the use of DGS resources for intervention other than payout will not itself cause the FOLF assessment. Finally, as regards the dangerous combo, financial cap plus super priority rule, it's recommended, inter alia, a broad flexibility in the least cost assessment, giving to the DGS the possibility to consider direct and indirect costs. I finish here, and thank you for your attention. Grazie mille.
Thank you. Thank you, Irene. Now the floor goes immediately to Serena for the comments as discussant. And in the meantime, I think I will be collecting questions from the box. So Serena, the floor is yours.
Thank you very much, Sebastiano, and thanks to the school and to the SRB for having me here as discussant. It's a great pleasure. I had the pleasure of reading your paper, Irene, as a member of the scientific committee reviewing the incoming papers, and now a second and a third time in preparation of this brief discussion. And I must say that it touches upon so many important aspects that it will be hard for me to limit my comments to a few key points. Now, the COVID-19 crisis indeed highlighted the immediacy of the need to tackle the weaknesses and the gaps in the EU's current crisis management framework. Hence, we are having this conference. And I think by discussing the role of DGSs in financing resolution and liquidation, and also in preventing bank failures, you address a key question in that endeavor. As you pointed out, the DGS directive assigns 3 functions to national deposit guarantee schemes, of which only deposit payouts and resolution financing, according to Article 109 of the BRRD, the so-called compulsory measures, are mandatory for member states to implement. Preventive measures to avoid the failure of a bank and alternative measures to preserve the access of covered deposits in the context of national insolvency proceedings were introduced in some member states, but not in others. Now, all 3 functions of deposit guarantee schemes may become relevant in the context of the COVID-19 crisis. And yet, as you highlighted correctly, deposit guarantee schemes have largely remained a sleeping beauty. And the question that we have to answer is, how can we awake them from their long sleep? Now, you identify a number of legal constraints in the process of rendering deposit guarantee schemes more effective for the funding in the context of resolution, liquidation, and crisis prevention. And I would like to touch upon some of them now in turn. Let me begin with a few remarks on deposit guarantee schemes and state aid. First of all, of course, state aid rules do not prevent deposit guarantee schemes from taking preventive measures, at least not in a legal sense. State aid rules just impose certain conditions on the receiving bank, of which the most onerous is, of course, the burden sharing requirement. That is the requirement for the bank's shareholders and subordinated creditors to bear losses before the DGS can provide additional funding. In fact, until the Terkas case, it was widely believed that measures taken by deposit guarantee schemes that go beyond deposit payouts and the limited contributions deposit guarantee schemes can make to finance resolution would generally qualify as state aid. The Terkas case changed this notion, as you pointed out, by clarifying the concept of imputability to the state in the context of deposit guarantee schemes. The effect that we see from that is that a double standard applies. Deposit guarantee schemes acting under a private mandate when deciding on preventive and alternative measures fall outside the state aid definition, whereas the state aid framework applies to deposit guarantee schemes acting under a public mandate. And clearly, this will incentivize deposit guarantee schemes to review their governance and legal status in accordance with the judgment, at least if that judgment is indeed confirmed by the ECJ. Now, the broader policy question that this raises, in my opinion, is whether we are ready for national deposit guarantee schemes to take preventive and alternative measures without the involvement of any EU-level coordination framework that would ensure some sort of level playing field. And that brings me to my second point. Do we need further harmonization of preventive and alternative measures by deposit guarantee schemes? As far as alternative measures are concerned, their voluntary nature appears to be in line with the EU's current regulatory and policy approach. Failing banks that meet the public interest test are resolved according to a harmonized set of rules, whereas all other banks are subject to national insolvency proceedings. Accordingly, national law may or may not provide for alternative measures to support liquidation action, depending on the specific member state's system and taste. Now, the case is less straightforward for preventive measures, as they become relevant in a period that is governed by a harmonized set of rules, the recovery period that precedes resolution and liquidation. And this may potentially speak in favor of harmonizing the use of deposit guarantee schemes for preventive measures, that is, for making them sort of compulsory in all member states. Now, the obvious elephant in the room here is the proposal or the idea to introduce a harmonized administrative liquidation regime, which would apply to medium-sized banks that are often largely deposit funded, and for which the current legal framework does not provide for an adequate solution, as they're often called to be too small to be resolved, but too big to be liquidated, at least at acceptable costs. Now, the introduction of such a harmonized liquidation regime in parallel to the resolution regime would require clarification of the sources of funding available under both regimes. And deposit guarantee schemes could play an instrumental role in funding orderly liquidation action, including transfer tools. This would imply that alternative measures would be harmonized across the EU. And to the extent this harmonized liquidation regime would include also pre-liquidation tool, it would imply that also preventative measures would be harmonized. Now, clearly, this administrative liquidation regime would have to ensure that no super priority ranking is granted to deposit guarantee schemes, as you also propose. And it would be beneficial to make access to funding dependent on the application of the least cost test. And this test would take into account not only direct, but also indirect cost of liquidation, as you suggest. But what indirect costs could entail would, in my opinion, have to be fleshed out in law, at least in terms of principles. I'm more critical of your suggestion to double the level of protection of deposits to 200,000 euros, even if there were indeed a need for such an increased coverage level, of which I'm not certain. Your suggestion is also politically very sensitive in light of the already stalled negotiation progress on EDIS. Now, I have two final points, or rather questions. The first relates to the failing or likely to fail assessment. You rightly pointed out that to the extent preventive measures by deposit guarantee schemes qualify as extraordinary public financial support, they would trigger a failing or likely to fail assessment, which is the very scenario preventive measures are meant to avoid. Now, we already have several exceptions in place that allow for precautionary support to be granted to banks without triggering the failing or likely to fail assessment. How do preventive measures relate to precautionary recapitalization, and do we need to extend the already complex provision of Article 32, paragraph 4D, or whatever it exactly is, of the BRRD, to include preventive measures? And finally, my last question: what are the implications of the TERCAS discussion for resolution funds? Should the same concept apply to resolution funds as well? And what would that mean for the single resolution fund, which has a status of its own? Before we open the floor for comments and give you the possibility to react, let me conclude by highlighting again that there is an urgent need to bring the rules on deposit guarantee schemes in line with the BRRD, the state aid framework, and the potential future liquidation regime. And I think that's the big merit of your paper, Irene, that you highlighted this need. And I can only encourage you to keep conducting research in this area. Thank you very much for your attention.
Thank you, Serena. And I see that there are a number of questions in your intervention, all interesting. And I now add a few ones that are in the chat for everybody, also those connected by phone, to understand. One question is how to concretely measure indirect costs in the case that the least cost criterion has to take into account also indirect costs in addition to direct costs. The other one is to give a role to the EBA to issue guidelines for the definition of direct and indirect costs, for example. Then there is another one that has just arrived, well, here it says that on deposit guarantee schemes, few countries like Greece and Portugal cover 100% of customer deposits, not only the guarantee amount. What is the impact of the 100% guaranteed customer deposits in several EU countries in relation with BRD? Well, I think that here the minimum is 100,000. So, I mean, this is the minimum harmonized. Finally, there is another question that asks a reflection on the discretion given by the directive on the fact that the DGS can have a public or private nature, and these can affect or not the intervention and implementation of state aid legal framework, creating different treatment among states. I would say, I would add to this, and under the framework of Serena, that effectively, I believe that, I mean, now we will see how this legal querelle at the European Court of Justice will end up. It will be interesting, but should the first level, the General Court sentence be confirmed, this would be, of course, a change with respect to what we have today. I mean, as in the same direction of the general advocate, of the court. But I believe, I mean, looking forward, I think that this is my questions, of course, that if we had an harmonized liquidation tool, a kind of a 28 regime, counting the UK outside, of course, as of the beginning of next year, only for banks, so a kind of administrative harmonized tool with, in the steady state, an EDIS, that's to say a fully fledged, mutually guaranteed deposit scheme at the European level, which could intervene, as the FDIC does, in essentially doing the transfer of a certain part of assets and liabilities to other buyers, which is the same thing that happens in preventive and alternative measures, as a matter of fact, respecting the least cost criterion, where direct costs, of course, have to be considered. Indirect costs, if considered, I believe they should be framed into legislation, because otherwise there would be an uneven playing field. This would already, I mean, probably address a number of problems of these small, medium-sized banks, which are today in an uncertain, uncharted territory. So I would like to hear from the presenter what she thinks about that. I think it is time to give her the floor, because otherwise we go to we go to beyond the allowed timeline.
Okay.
So Irene, the floor is yours.
Yeah. There are a lot of questions that, I mean, I'm happy because it means that the topic is interesting, and then I will try to organize my answer, dividing them in two blocks. First of all, the problem of state aid. When I say that the governance of the DGS were in the past not relevant according to EU law, I refer to the fact that we had cases that have been brought in the front of the European Court of Justice. I refer to the Sicil Cassa case and the Banesto case in the past. And for example, in the Sicil Cassa case, our deposit guarantee scheme was the same that now. So, and in the Banesto case, the Spanish one was public at the time, and the European Commission never held that this was a problem. Neither the public governance of the DGS. Okay, so I believe, although I was soft in my remarks and concluding remarks, that state aid rules have not to be applied to the DGS interventions, because in general, they are not the condition, also if we look inside the case law, but in particular because the resources are private, and the DGS are instruments that are necessary to assess the problem of the middle class, okay, and not only the middle class. So as regards what Serena recalled, the exemption of regarding to Article 32 of the BID, I think that we don't have to add an exemption. We should only to not apply the state aid rules to deposit guarantee scheme, at least not in the strict way. Why? There's another point that Serena underlined that is important, and it refers to the problem of the public resources. Because if we insist, if we stress the point that the resources of the ADGS are public, we have to apply the same rule to the resolution funds, in particular to the national resolution funds, because as we know, the BRID and the SRM regulation equate the use of DGS funds to the use of resolution funds. Now, it's clear that it's not possible to put in the perimeter of this rule the funds that are used at European level, because the Single Resolution Board is an European agency. But if we want to be strict, and if we want to say that the DGS use public resources, we have to apply the same concept to the use of national resolution funds, because in that case, there's a public governance, there's a public control over the funds, it's a mandatory for banks to contribute to the national resolution funds, and the resolution authority decide by itself how to use these resources. So if we want to be coherent, we have to, apply the same rules. So it's necessary, according to me, to be more flexible and put this kind of resources outside the state aid control, at least if we think to the really strict approach of the European Commission. As regards the elephant in the room, the EU liquidation regime, this proposal is really straightforward. I would be happy to have a common harmonized liquidation regime that is needed because a lot of reasons. First of all, the liquidation in general, it's negative. It interrupts the bank's main functions. And also we have to consider that the DGS is not able to face an important insolvency because it doesn't have enough resources to do that. So the best solution is the sale of business strategy, because in the sale of business strategy, the contribution that is required to the DGS is less than the deposit payout, in particular if we take into consideration a bank with a big bank, okay? So I believe that we have to go to this direction, but it's going to take time and also a political agreement. To the creation of a common European liquidation framework that entails the sale of business like the main strategy. I think that we have firstly to assess some key points of the insolvency regime that have to be really harmonized. I refer to the fact that, for example, the condition for resolution and the grounds for insolvency are not the same. In a lot of member states, in Italy are the same, but it's not in this way in all the member states. We have to consider that there's not an alignment regarding the condition of public funding in resolution or liquidation, because we have two different regimes. Also, we have to consider a big issue is the problem of the creditor hierarchy within the insolvency procedure. Also, this kind of the sector of the insolvency regime is different. Although, the BRID framework introduced some harmonization on this point. So I believe, and also, this is another point that Sarina arose, is the fact that it's important, it is necessary that we go to a strong harmonization of the preventive and alternative measures, because they are not compulsory now. And so it means that not all the member states use this option. And if we want to use it, if you want to go to a full harmonized liquidation procedure, we have also to harmonize this point. And in order for all the member states to introduce this option. And if I didn't miss something, I would like to go to the point of the indirect costs. There's an opinion of the EBA on this point that released in February 2020 that I referred in my paper. The EBA asked if the directive contains in itself the possibility to use indirect costs, and I believe so. Although it's clear that it would be needed more clarification on this point. Regarding the list costs, what are these list costs? Regarding the indirect costs, what are the direct costs to be taken into account? I think that maybe it's good. It would be good for the EBA to set a list. But what I wanted to say in my presentation is that it's not to be, according to me, is not fair, it's not desirable to write a sort of fixed list, because our regime, the main problem of our resolution regime is the fact that there is a small space for discretionality, and it's needed discretionality when we deal with a bank failure, because every bank is different, every regional situation is different, every market is different. So we have to give to the DGS and to the resolution authority a margin of discretion in deciding which kind of indirect costs have to be taken into account. I don't know if I answered to everything and I missed something, because there were a lot of questions and
Okay, I think that we have exhausted our time of this session. So I would thank all the panelists and presenters and discussants, and also the colleagues that made questions in the chat. I think it was a rich session, and I would hand over now to the organizers. I think we have a short break before we take it up again. Thank you.
Thank you.
Yes, thank you. Thank you, Sebastiano. Yes, so this was very interesting. Now that our legal session ended, we'll indeed have a mini break, as they say on TV, and we'll then reconvene for Mr. de Carpentier's keynote speech, which will focus on the impact of COVID, of the COVID crisis, and on the SRB's actions and priorities for the years to come. After that, we'll go straight to our economic and financial session. So stay tuned and see you at 10:52 sharp. Thank you. Welcome back. So let me ask our panelists to tune back in, please. We will now move to our keynote speech session, a session chaired and moderated by Professor Elena Carletti from Bocconi University and the Florence School of Banking and Finance here at the UI. The keynote speech will then be delivered by Jan Reinder de Carpentier, Vice Chair of the Single Resolution Board. Elena, the floor is yours.
Thank you, Pierre. Thank you very much. And good morning to everybody. I'm very happy to participate in the conference. And again, on behalf of the Florence School of Banking and Finance, let me thank also from my side the Single Resolution Board for the cooperation on this conference. I'm delighted to welcome Mr. Jan Reinder de Carpentier, who is the Vice Chair of the Single Resolution Board, and I'm very happy to chair his keynote speech. Before giving the floor to you, Mr. de Carpentier, let me just remind the rules. So the speech will last 15 minutes, and then I hope we will have 15 minutes for discussion with the speaker. So be reminded once again to please write your questions in the Q&A box and not in the chat box. Without further ado, let me give the floor to you, Mr. de Carpentier, for your speech.
Thank you, Elena, and good morning, ladies and gentlemen. I'm sorry that our chair, Elke Koenig, could not be here this morning. As Vice Chair of the SRB, I want to thank you for your interest and for your work on the area of resolution. Bank resolution is a relatively new field, and your research, thoughts, and ideas will no doubt feed into future policy decisions, be it in Europe or elsewhere in the world. This morning, I'll look at the impact of the COVID crisis on the financial sector and the response of the SRB to the pandemic. Then I will outline the SRB priorities for the coming years, with a particular focus on the SRB's multi-annual work program for 21 to 23, which is hot off the presses this week. Finally, I'll share some thoughts on changes that could be made in the current resolution framework. So with that, let's take a look at the impact of COVID. The pandemic represents an unprecedented shock for the European economy and worldwide. The autumn economic forecast of the European Commission, published this month, is broadly in line with the ECB's GDP forecast. The euro area economy will contract by 7.8% in 2020 and will recover by 4.2% in 21. It is clear that we are in a crisis, and if one were to look at these figures alone, we could say it is even a more severe drop in GDP compared to the crash of 2008-2009, when GDP has fallen by 4.5% in the euro area. However, there are some key differences. Vaccines are on the horizon. Recovery is expected to be much quicker than the last crisis. And of course, the banking sector is not the cause of this current crisis. Banks are much stronger today in terms of capital and liquidity, thanks to the regulatory reforms, including the banking union and the SRM. So what impact is the crisis having on resolution? If we look at the buildup of the MREL first, it continued in the current year, although at a slightly slower rate. In the first 2 quarters of 2020, banks issued almost 180 billion euro in eligible funds, an amount just 4.7% lower than in the previous 2 quarters of 2019. A slowdown, yes, but not as severe as might have been expected. Since Q3, markets are definitely back to normal. After the volatility of funding costs of subordinated and senior bonds and yield to maturity of subordinated debt peaked in March, the cost of funding materially decreased over the summer period until mid-September 2020. Clearly, banks must keep up the momentum on increasing MREL, since it's vital to strengthen resolvability, and especially given the new obligations in the BRRD2. And banks should tap the market to build up MREL. To be clear, banks cannot and should not wait for better times. Overall, the vulnerability assessment carried out by the ECB in early summer shows good signs of a resilient banking sector. However, there is no reason to sit back and relax. For example, under the more adverse, much less probable scenario, capital depletion could lead to an average decline of 5.7 percentage points in core capital, the Common Equity Tier 1 ratio, with a potential increase of non-performing loans to around 1.4 trillion. This would be much higher than in the Great Financial Crisis. This might be a worst-case scenario, but the only logical conclusion is that banks need to focus on their risk management and need to address the topic at first sight. Again, wait and see is normally not a successful strategy. The uncertainty caused by COVID is a risk for financial stability, so all the more reason for strengthening our resolution framework so we can manage banks' failures effectively if and when the need arises. However, if banks work now on issues such as provisioning for NPLs and risk management, then the risk of bank failures will decrease. As regards the response of the SRB to COVID, we had to balance the need to provide relief to banks to face the current economic challenges and the need to make progress on the requirements to become resolvable, which is more important than ever. On the operational side, we postponed less urgent information or data requests in line with the EBA's recommendations. On the whole, banks managed to respect the limited extension of the deadlines, and therefore our 2020 resolution planning cycle remains well on track. In terms of MREL requirements, since the legislation envisages that the capital buffers are added on top of MREL, the SRB has implemented the capital relief measures taken by some national macro-prudential authorities. In addition, as regards existing binding MREL targets under the BRRD1 rules, the SRB announced that it would have taken a forward-looking approach to banks that may face difficulties in meeting these targets before new MREL decisions under the new BRRD2 rules take effect. The SRB will also continue to monitor carefully market conditions and reflect the potential impact on transitional periods needed for the buildup of MREL in its 2020 MREL decisions. This pragmatic approach provides banks with the flexibility they may need in the coming months. But I want to be clear. Flexibility cannot be at the expense of our core mission to promote financial stability and protect the taxpayer from having to bail out banks. Now, ladies and gentlemen, I want to move to my second point, the SRB's program for the next years. Indeed, in the coming days, we will publish our multi-annual work program covering the period 21-23. I might take you through a few of the key points. On resolvability, the focus will be on the implementation of the expectations for banks. It's the SRB's guidance for banks to increase their resolvability gradually to become fully compliant by 23. This is translated for individual banks in annual tailor-made work programs by the SRB, known as priority letters. The next resolution planning cycles will be crucial to reach that deadline of 23, which is also the deadline for the MREL targets to be met. We will be monitoring progress and clamping down on breaches. In the coming 3 years, the SRB will refine and update the MREL policy to complete the implementation of the banking package, including guidance to respond to MREL breaches, implement the new provisions of the eligibility framework, as well as the EBA RTS on various MREL-related aspects. The SRB will also use the tools at hand for banks not making sufficient progress, such as the impediments procedure. The SRB will continue to focus on policy development of our core resolution principles in the next 3 years. On crisis preparedness, a key focus will be on resolution tools other than bail-in. In 21, work will concentrate in particular on the operational preparatory steps for the sale of business tool. In addition, we continue to perform crisis simulations, so-called dry runs, which is a very valuable exercise to identify areas for improvement. Finally, some thoughts on changes to the resolution framework. The completion of the banking union over decades since the last crisis is overdue. There are a number of issues the SRB would like to see dealt with. We still have different national insolvency rules, and this causes a number of issues, as you're well aware. Not least, the no creditor worse off principle, which seeks to ensure that the treatment of creditors in resolution is not worse than the treatment they would have received under normal insolvency proceedings. This becomes very difficult to assess and to meet with different national procedures, and for cross-border banks may result in different outcomes, depending on the home country of the institution, so an unlevel playing field. The second topic, which is also under discussion among policymakers, concerns the challenges faced by medium-sized deposit-funded banks. They lack an easy access to wholesale funding markets and could be too small to be resolved, but too big to be liquidated. We have an issue in the banking union where some banks are too critical to be put into national insolvency proceedings, but yet cannot be burdened with requirements such as MREL. However, all banks under the SRB's remit must be resolvable, either by using resolution tools or under the national insolvency procedure. A possible solution to these gaps would be to establish a harmonized administrative liquidation regime backed by a common insurance scheme to finance the transfer of assets and liabilities. The creation of a fully mutualized deposit insurance scheme remains a priority for the SRB. Another area we would like to see progress on is the further development of the Capital Markets Union. I will come to a conclusion, ladies and gentlemen. Looking at the response of European authorities, I think we can say it was swift and it was coordinated. I hope that we will use this crisis to come out the other side with a stronger resolution framework. I have no doubt that academic research, combined with the real-world pressures owing to the pandemic, will help in this process. So I want to thank again all of those conducting research in the area of resolution. It is very useful in our work. Thank you.
Thank you very much. This has been very insightful. Let me start by asking you a question as I take the advantage of being a chair, and then I go to the audience question, and please feel encouraged to ask a question in the chat box. So one thing that you said is about the MREL, that somehow there is no relaxation in terms of even timing of the MREL at this stage, if I understood correctly, and that you are very carefully monitoring though the market conditions. This is somehow, and not to push for relaxation of the standard, not at all, as you stressed in several occasions, but this is somehow in a different, if you want, attitude or way of proceeding relative to what we have seen, for example, in the SSM, that has been more relaxing more from the start a certain requirement. So the question is to you is, I understand the need of remain strict on this requirement, and I can agree with you. But on the other hand, this sort of case by case or development of the market condition may lead to some uncertainty. And banks, on the other hand, need certainty for their funding plans. How do you see the tension between the two? I mean, do you see a tension between, on the one hand, monitoring the market condition by giving certainty, or you don't see that tension in your view?
Well, I think first of all, what is important is like I said, we are in a crisis situation, and building further resolvability of banks is key. So that I think is the starting point. At the same time, I think it's important to kind of explain again that yes, we are very mindful of the situation, and that's also the reason why we have provided tailor-made kind of extensions of deadlines to submit information, etc. So we have really tailored our approach, but also, and I think more importantly, we have taken a real forward-looking approach, saying, okay, let's have a forward-looking approach, looking at the new framework, setting then the intermediate and final MREL targets under the new framework. So making sure that we can also, in terms of transitional periods, take a case-by-case approach. So I wouldn't say that we are there, deviating from a general approach of being very mindful about the current situation. But you're right in terms of, if you look at the overarching risks, that of course, building resolvability of banks is something that needs to proceed. So there, I think we have taken a balanced approach. I wouldn't say that we have kind of deviated so much from the SSM. We have a different role to play, but I think we have taken a very balanced approach there. Thank you.
Thank you. First of all, I have a requirement, please, for the Florence School, or who is managing the webpage. If you can clean, please, the Q&A box from previous questions, because otherwise I can't read very well those that come from Mr. De Carpentier. So let me just read the one that I see on the screen, which is, are there any thought as to the SRB response if some banks don't comply with the MREL interim binding targets? Do you believe that the coordination with the SSM is adequate in that respect?
Yeah, I think the cooperation with the SSM is excellent, and it's a key feature of a well-functioning banking union. So we have built the two pillars. We're very much looking forward for the third pillar, as I said in my speech. But this can only work well, the system, if there is close cooperation between those various legs playing their own roles. So in that sense, I think there is excellent cooperation. I think, again, like I said, we take a very much forward-looking approach. So indeed, the transitional periods are for us a key way of looking at specific situations and to address that where needed. So I think indeed, there is a good alignment with the SSM. And we take that as the best way to deal with the current situation. Again, balancing between the challenges that this crisis poses, and at the same time, so making sure that we continue our path towards resolvability, but also being mindful of the individual situations of specific banks. So I think that is the balance that we strike, but definitely in close cooperation with the SSM, because again, we can build a banking union with three pillars, currently two, hopefully soon three. But this will only work if you have a very good cooperation, each pillar playing their own role, but in very good understanding of the various responsibilities.
Thank you. Another question from the audience that somehow is close to my heart is on the heterogeneity. So you mentioned that the worst case scenario with the NPL increasing to over 1 trillion, and you actually made even the highest number of the range that is given, because you said 1.4, normally it's 1.2, 1.4. So you went really somehow negative in that sense. But of course,
in a very exceptional
in very exceptional, yes.
I was conservative there.
Yeah, but you were given the highest number, which is fine. It's the most, it's the worst possible number that we have read in the SRB vulnerabilities exercise indeed. So, but of course, this has a lot of heterogeneity across member states. So the question is, are some countries more exposed than others? And of course, we know that some of the countries have still an NPL legacy to deal with. That is obvious. But in terms of the future NPL that we may see, do you see a big heterogeneity across countries, or do you think it's more somehow equally spread across the countries?
Well, thank you very much. And again, you know, I was referring indeed, like you said, to the worst case scenario, and not to other scenarios. So I think don't get me wrong there. I don't think I deviate from the scenarios that have been put on the table. I always say I don't have a kind of a glass ball on my desk, a crystal ball telling me, you know, how things will develop in the future. So we have to closely monitor what will happen. One thing for sure, you know, banks with certain issues and challenges before the crisis has hit us will definitely not be in a better position now that they have to face also with the consequences of this unprecedented COVID situation. So that is something for sure. You know, how this will balance out between the various countries and where we might see more difficulties than in others. Again, I cannot speculate. We have to really see how this crisis will unfold, and this will take a bit of time. And there will be a certain time lapse between what we see happening at the moment and when we will really see the impact for the banks, and how this will then unfold in the various countries. Like I said, I simply don't have this crystal ball to tell you. One thing for sure, like I said, you know, we need to monitor the situation closely. It's good that we work together also with the academic side to keep on building and deepening the banking union. And there's a clear need for focus from banks on their risk management side to make sure that there's adequate provisioning for NPLs. So that would be my response at this stage. Thank you.
Okay, thank you. Another question that I find very interesting from Alex Lehmann at the Bruegel. Prepositioning MREL as mandated under the BRD2 will further fragment the euro area financial market at a critical juncture. How will the SRB support the objective of cross-border risk sharing, e.g. through encouraging single point of entry schemes as default and intra-group financial support arrangements as originally foreseen for recovery plans under the BRD? It's a quite technical and complicated question. I hope you understand.
Yes, I would like to open another discussion, but I think this might require more than an hour. So basically, this question is quite interesting and has a lot of angles, but I find it difficult to really answer that in a comprehensive way. I don't think we are on a path to fragmentation. To the contrary, I think the SRB is very much focusing on the current framework in terms of, you know, having as far as possible a level playing field, and at the same time, you know, also pleading, of course, for further strengthening and deepening the banking union to address a couple of things that are related to the items that were just raised. So I wouldn't say that we are on a path to fragmentation, to the contrary, but of course there are certain challenges where also home host issues are of course on the table, and we see that there are also some rebalancing it takes place. So I think that is something where definitely progress needs to be made. I was already referring to the harmonization of liquidation regimes, which definitely would strengthen the deepening of the banking union, and is, I wouldn't say on top of our wish list, but a very important item. So we need to build trust in this system, also across borders. And I think there the SRB is in the lead and takes a leading position, and we will continue to do so going forward.
Let me give you a question that is more of a breath in a way, from Sebastian Mark. You stress a lot the importance that banks are resolvable, and rightly so. And going forward with potential impact of COVID, this is, it's clearly a very top priority. The question is, as of today, how many banks under the SRB remit would you consider fully resolvable? That is free of any substantial impediment to resolvability. I know it's a bit of a provocative question, but take it as.
I think the longer the session takes, the more difficult the question seems to be. So
we have 2 more minutes left.
No, I think, you know, this is a very valid and good question. Like I said, you know, we're working very hard. Building resolvability is a journey, and I think we have made tremendous progress. it's you know also very well, you know, they're very lax, very lax to this. And so building Amber is a key aspect. You know, further working on our resolution plans, where we really made a lot of progress during the last years to make them fully implementable. That all has to do with basically the same side of the coin, making banks resolvable. So a lot has been achieved, and we continue to work hard together with the banks, together with our stakeholders, also together with the academic world, to keep on deepening and strengthening this regime. So, like I said, a lot has been achieved. We feel that we are in a far better position there than, of course, when we just started to build this project, if I may call it this way. So the SRM. And I think together with our stakeholders, we have made enormous progress in terms of resolvability. And there, like I said, MREL building is playing an enormous important role. I was already addressing there some of the numbers of what is happening at the moment, but also making fully executable resolution plans, and also the buildup of the organization itself, if I may. The SRB is now a grown-up organization, fully staffed, fully prepared, focusing very much on its readiness to deal with whatever crisis might come. I think is an important ingredient, and this also provides trust, definitely in certain circumstances as we currently face. So looking forward to an even more complicated question.
No, let me just take a question from myself again. So I don't, maybe it's just shorter because some of the chat box are quite long to read and we are exhausting our time. You mentioned the no creditor worse off principle. Funny enough, I was actually teaching it yesterday to my undergraduate students, and I was stressing the difficulty of implementing it in practice, and you just repeated the same concept. How do you think could be an improvement to this principle? I mean, it is nevertheless an important principle to maintain, because from the creditor perspective, clearly they, I mean, otherwise they could say, well, let's go for liquidation rather, right? So we can't really hurt them. But given the operational difficulty of this principle, what can we do to improve it?
Well, you know, it is an extremely important principle. It's one of the foundations, basically, of what we have put in place. So it's a very important protection for investors to know that whatever happens, that this principle is at the end of the day something that will be addressed, and where needed, compensation will take place. So for me, this is a founding principle of the SRM, and therefore a very important one. But what makes the whole system so complex, legally, you know, I'm a lawyer, so also very interesting, of course, but complex, is indeed the interrelation between basically European law and national insolvency laws. So there is this interesting link that you see in various aspects. I don't want to open a legal debate, but in various aspects of the framework, you see this interesting cooperation, interaction, basically, between the national legal regime and the European legal regime. And there, indeed, you see, like I said also in my opening remarks, that this is high on our priority list, that the better you harmonize basically your national insolvency regimes, and this is a long and difficult journey, but we would definitely like to see some progress there. You know, the more you harmonize it, the better basically this interaction between the European level and this national level will work. Because at the moment, for no creditor worse off, you really look at the ranking at national level under national insolvency regimes, which means that at the end of the day, although we have done a lot to achieve a level playing field, there are still these challenges due to the different outcomes per country. So there, like I said, it's top of our list. I also know that this is not kind of low-hanging fruit that will be realized easily, but I think to further deepen the banking union, this is a key aspect where progress needs to be made.
Yeah, I definitely agree with you on this point. So it's 11:20, so we are already running a bit late because of the start. So let me stop here the discussion. Let me thank you very much for your speech and for your answers to the difficult questions that were coming up. So thanks again, and let me give you a virtual applause and give the floor back to Pierre. Thank you.
Thank you.
Thank you very much, Elena and Mr. de Carpentier, for this inspiring session. Time to move on to our second session of today, chaired by Professor Tobias Strugge. I see that you're connected and online. Professor Tobias Strugge is a very experienced academic in financial law, holding the chair of private law, trade and business law and jurisprudence at Goethe Universität Frankfurt am Main. Since 2016, Tobias is a program director corporate governance and corporate finance at the Research Center SAFE, and since 2018, the director of the Center for Advanced Studies, Foundations of Law and Finance. Professor Tobias Rügge is also a regular instructor in FBF training courses. I will now immediately hand over to you. I remind everyone that it's important that for the questions you address them in the Q&A box, but I think until now, many of you have done so. Tobias, the floor is yours.
Thank you. I'll only take it for a couple of seconds because I think time is of the essence, and I remind our speakers that they also stick to the timing that was made transparent to them up front. And therefore, I'm extremely lucky to chair the session, which will feature Nikos Maragopoulos, who is an associate researcher at the European Banking Institute, presenting his paper on removing the regulatory barriers to cross-border banking, regulatory initiatives, foster banking integration, and financial stability in the banking union. And his discussant will be Nicola Costa, who joins us from the SRB, where he is a senior bank recovery and resolution expert. And so without further ado, over to you, Nikos. Floor is yours.
Good morning. First of all, I would like to thank you for giving me the chance to present my paper at this event. Just a minute. My paper is related to an issue that has been discussed a lot during the past years, and this has to do with the need to remove regulatory barriers to cross-border banking. Regulatory barriers that still exist in the banking union even after its establishment, and prevent banking groups from managing efficiently their capital and liquidity resources across borders, affecting thus their profitability and as a result their financial situation. I think that this issue will become particularly relevant, even more relevant during the coming years, when banks will have to deal with the stock of NPLs that will be created during the COVID-19 crisis, and they have to take action in order to address this problem. But first, let's see where we stand. You can see in slide 3 at the left side, euro area banks enter this crisis with higher capital buffers and stronger balances compared to the situation prior to the inception of the SSM and the SRM. Also, they have started building MREL buffers under the SRB's guidance. However, there are still some concerns about the euro area banking sector, and these mainly refer to low profitability of banks. Since many banks in the euro area have a return on equity which is below their cost of equity, and this is owed to many reasons, such as the negative interest rates, the high impairment charges that banks have to take in order to deal with NPLs coming from past crises, and the overcapacity that still exists in the banking union. Also, another problem is related to financial integration that has significantly retreated during the past decade, as shown by the low number of mergers and acquisitions that took place, particularly on a cross-border basis, and the significant dispersion in loan and deposit interest rates across the euro member states. One of the reasons for this problem is related to the still existing regulatory barriers to cross-border banking. And these regulatory barriers have two dimensions. Under the first one, subsidiaries located in different participating member states are still obliged to meet individual prudential requirements, namely capital requirements, liquidity requirements, and internal MREL, while at the same time, subsidiaries located in the same participating member state with a parent entity may avoid meeting these requirements in case that certain conditions are met and they have the consent of the supervisory authority and the resolution authority. As a result, unnecessary capital and liquidity burden is placed on banking groups, since they have to hold capital and liquidity at subsidiary level in order to meet those requirements. The second dimension of those barriers is related to the power that host member states still have under the CRR to prohibit the exemption of cross-border intra-cross-border exposures from the large exposure limit of 25% of Tier 1 capital. Based on Article 493 of the CRR, member states may retain until 2029 this option, which prevents bank groups from transferring liquidity among their groups, among their entities. As a result, there is a problem that subsidiaries have excess liquidity, which have no other option than to invest it in assets with low or even negative interest rates, or even to deposit this at the central bank, while at the same time the parent entity is in need of that liquidity in order to meet prudential requirements or to cover its funding needs. And it has to resort to more expensive funding sources for that purpose, such as to make some repo transactions. As a result, this problem affects prevents banking groups from managing their capital and liquidity resources in an efficient manner, and affects their profitability and the sustainability of the business model. What I'm proposing in order to deal with this problem is the amendment of the regulatory framework, mainly CRR, BRD, and SRMR, through the introduction of some regulatory initiatives which can be formed into 4 pillars. Under the first pillar, the restriction to transfer of liquidity, which I described earlier, should be lifted in order to allow banking groups to manage their capital liquidity resources in the way they consider appropriate. Under the second pillar, subsidiaries in different participating member states should be subject to reduced prudential requirements, which means that only Pillar 1 and Pillar 2 capital requirements should apply at individual level, while capital buffers in the Pillar 2 guidance should be met only at consolidated level. As regards liquidity, the LCR should be waived at the subsidiary level, and the parent entity should grant guarantees to the subsidiary equal to the LCR denominator that the subsidiary would have to meet in case an LCR waiver was not already in place. And lastly, as regards internal MREL, the recapitalization amount of the internal MREL, which is the second component, should be covered with guarantees granted by the parent entity, while only the loss absorption amount, which is the first component of the internal MREL, should be covered with preposition capital instruments, since subsidiaries will be subject to Pillar 1 and Pillar 2 capital requirements. Also, under the third pillar, the ECB and the SRB should be assigned with enhanced powers to set stricter prudential requirements in case they assess that the riskiness and resolvability of the subsidiaries justify such a decision. So, based on the SRB assessment carried out by the ECB and the resolvability assessment carried out by the SRB, the aforementioned capital, liquidity, internal requirements may be set at a higher level and maybe more, maybe stricter, in order to address potential problems that the subsidiaries may have. And lastly, under the fourth pillar, all banking groups wishing to take advantage of this preferential treatment should sign on a mandatory basis inter-financial support agreements, which are already provided in the PRRD, based on which the parent entity will commit supporting subsidiary in case the latter is in need of capital or liquidity. Also, all subsidiaries enjoying this preferential treatment should be covered in a group recovery plan, and not only as per the current regime, the subsidiaries which are considered significant for the host member state or for the group, but all subsidiaries that are taking advantage of this preferential treatment. And as a last point, the ECB and the SRB should be conferred with enhanced or intervention powers, based on which they could require from a subsidiary and its parent entity to take action and restore potential deterioration of the financial situation of the subsidiary in case needed. The ECB should have the power to extend these early intervention powers also at the parent entity level, in case the parent entity is reluctant to take action in order to restore the financial position of its subsidiary. As regards the third pillar, which I mentioned earlier, the ECB carries out on an annual basis the SRB process, based on which it assigns a score of 1 to 4 on its bank under its remit. For instance, if a score of 3, which is a medium low score, is assigned to a subsidiary, this means that the ECB could require from that subsidiary to cover a higher portion of the P2R with CET1 capital, for instance 86%, while the default number based on the CRP5 is 56%. Also, it may require from that subsidiary to cover half of the guarantees granted by the parent entity with collateral eligible for illiquid plus high quality liquid asset. Respectively, the SRB could adopt a similar approach in order to assess the resolvability of subsidiaries. And in case a score of credit was assigned on a bank, it would require half of the guarantee granted by the parent entity, the subsidiary, to meet the recapitalization amount to be collateralized with a collateral eligible under Article 195 and 97 of the CRR. Based on this proposed approach, banking groups would be incentivized to place particular emphasis on the risk and resolvability of their subsidiaries, since they would know that in case that they do not take action in order to address potential risk management problems or the asset quality or liquidity position of their subsidiary or the resolvability, the ECB and the SRB could set stricter potential requirements. And also, this issue provides some relief to host member states, since they would know that not all subsidiaries are treated in the same manner, but risky ones are have higher prudential requirements to meet. Under the proposed escalation mechanism, as I said earlier, all banking groups enjoying this preparation treatment should sign on a mandatory basis intergroup financial support agreements, and all subsidiaries should be covered in the group recovery plan. This means, for instance, that if the settlement ratio of the subsidiary falls below the recovery trigger, the senior management of the subsidiary should consider implementing the recovery options that are included in the group recovery plan. And if it decide to not take action and the financial situation of the subsidiary continues deteriorating, the ECB and the SRB should step in and take early intervention action measures. Which means, for instance, that as currently provided in the PRT, they may require the implementation of recovery options on a mandatory basis, the activation of intergroup financial support agreements in order for the parent entity to transfer liquidity and or collateral to the subsidiary, or even the SRB could require from the subsidiary to cover the recapitalization amount in full with collateralized guarantees or preposition emerald instrument. In case the parent entity is reluctant to take action in order to address these problems of its subsidiary, the ECB could extend these early intervention powers to the parent entity and may require to take action. If the parent entity is not willing to do so, the ECB could end up removing the senior management of the parent entity, or even appointing a temporary administrator, as is already provided in the BRD. I think that this proposed mechanism would force banking groups to take action on their own early enough in order to address potential problems that their subsidiary may have, and to avoid the intervention of the ECB and the SRB, either at subsidiary or even more at parent entity level, which will have significant financial and reputational impact for the banking group. The proposed regulatory initiatives seek to promote both financial integration and financial stability through various channels that are shown in this slide, mainly through the enhancement of banking groups' profitability, which would allow them to take action in order to address also the impact of the COVID-19 crisis, for instance, through the increase of the provision coverage, or through actions such as sale of NPLs or securitization of NPLs that will come from the COVID-19 crisis. Also, these regulatory initiatives could allow banking groups, could urge banking groups to place emphasis on risk management and resolvability of their subsidiary in order to avoid any risk of the potential requirements applied on them. Furthermore, I think that if these regulatory initiatives were accompanied with the completion of some institutional reforms that are discussed in the public debate, such as the establishment of the European Deposit Insurance Scheme, conferring upon the ECB of the function, or the establishment of fiscal backstop to the SRB, this would alleviate to a significant extent the concerns that host member states have about the removal of those regulatory barriers, and would allow them to adopt these regulatory initiatives. And the last point, particularly in environment in light of the COVID-19 crisis. These proposed regulatory initiatives cannot address on their own the impact that this crisis will have, but could contribute to addressing this impact along with other systemic solutions that are currently being discussed, such as the establishment of asset management companies either at European or at national level, or the amendment of the regulatory framework for precautionary capitalization, or even initiatives that the banks may take on their own, such as capital increase that they may want to proceed. Particularly as regards the last point, but if these regulatory initiatives were not in place, banking groups would have a story, narrative towards investors that in case that they participate in this share capital increase, they will enjoy enhanced increased profitability from that could arise in the coming years, either due to their operations in foreign jurisdictions or due to their intention to proceed to more cross-border M&As. And I think that another argument in favor of this proposal is that it does not entail any fiscal cost for host member states, in contrast to other solutions that are currently being discussed. So I think that this is an additional argument for member states to endorse these initiatives, even after many years of discussion about them. Thank you.
Thanks, Nikos, for also sticking to the time. So I immediately turn over to Nicola, who will discuss this proposal. Nicola, what is yours?
Thank you, Tobias, and thank you, Pierre, and to the FBF team. Let me start by thanking the author, Nikos Maragopoulos, for his very good paper and presentation on the almost issue and on the fragmentation of the internal market in relation to banking groups. After having heard this morning about precautionary capitalization and DGS, I think it's great that now we have the opportunity to discuss and talk about the almost debate, which is a hot topic in the current regulatory forum. I have to say that I found the paper of Nikos very well structured. Section 2 on the existing framework, which correspond to slides 4, and section 3 on the proposed framework of Nikos, which correspond more to slide 6, each deal first with capital and liquidity requirements, internal MREL, secondly, and thirdly on intragroup exposures. And I have to say that I particularly appreciated this paper because it also puts forward concrete solutions. Now, to put a bit more also the paper into the ongoing policy discussion and context, I thought of proposing to you, as you can see in the next slide, a somehow parallelism with another eminent proposal which was recently made in October. That tells you also that Nikos was ahead of them with this paper of the ECB, but I think it could be interesting as a comparison, even if it needs to be recalled that there are different type of communication and different type of media. So, you know, a full comparison doesn't really hold, but it could be a good flavor. If we look at on the one end on the blog post of the ECB and on the other end on the paper, we see that the blog post mainly focuses on liquidity waivers, while Nikos' paper addresses both liquidity and capital waiver. The blog post does not tackle the possibility of cross-border internal MREL waivers, while the papers already puts forward that idea. And the paper, the blog post also already mentioned a potential revisions of the already foreseen in BRRD intragroup financial support agreements, but in the view of the ECB, they would remain optional. While the paper indicates that the intragroup financial support agreements should be mandatory for those wishing to apply those waivers. So here, a first set of questions also for reflection. I mean, would it make sense, in order to make progress, to have a gradual step-by-step approach as proposed in the blog post? Or would it make more sense to go directly for a more comprehensive, but at the same time more complex plan, as suggested in Nico's paper? On this also, I would be happy to hear also the views of the author on the ECB blog post. Now, moving to another slide. So, thank you. So the author, as he briefly mentioned, also puts forward additional ideas and proposals that I'm just briefly mentioning that, so that group recovery plans should cover all the subsidiaries enjoying the proposed preferential treatment, then enhanced early intervention measure on a group should be on a group-wide basis, and that recapitalization of subsidiaries should be at the point of non-viability. Here, I wanted just to flag two elements and to bring them to the debate. So the first one, which was in slide 7 of Nico's. So the idea of a connection of internal MREL to the potential resolvability assessment scoring, and linking that to collateralized guarantees for the recapitalization amount. I think it's an interesting concept that could make sense, but I think that further work would be needed, and in particular empirical analysis to see whether this idea proposed by Nikos could be concretely translate into proper practice. And for example, linking, as he mentioned, this was explained in his slides, the percentage, so 25, 50, and 75%, as it was mentioned, to a scoring of resolvability assessment might be a bit too automatic approach. So that should be considered carefully with further studies, in my view. Now looking at is slide 9, so which I have to say is a very interesting slide and very complex. So congratulations again to Nikos for putting and linking all those concepts into one single slide. And overall, I have to say that I share his ideas. But here, a word of caution on one element. The idea that the liquidity and resolution issue would be mitigated through mobilization of collateral held of subsidiaries. So that is partially true, and it can be intuitive, but I think that we need to be careful and clear at the same time that even if that would partially happen, that will definitely not solve the real and fully liquidity resolution problem. So I would believe that some further analysis would be welcomed also on this element. Now I'm going towards a conclusion of my very brief intervention, and I have to say that in general, I think that for the further analysis and studies, it could be beneficial also to looking at past experiences and also at other jurisdictions in the globe to see which policies regulatory policies could be more correlated than others to cross-border integration. So which policy led in the past to more cross-border integration? So I think we may have some, might have some lessons to learn from the past or from other jurisdictions. So I think that it will be beneficial to do further studies in that direction. If quantitative is possible, better. Otherwise, also qualitative approach could be undertook with surveys and interviews to bank management. A final remark, I was wondering how the author could make even more clearer with an analytical analysis how the home and the host would benefit from the proposals made, and how the home and host could be made comfortable with ideas proposed in order to unlock the current policy discussion. Thank you very much for your time.
Yeah, thanks, Nicola. I will immediately pose some questions that have popped up in the chat before I would also like to highlight a couple of points. But maybe first, a very short one, which simply says, isn't branchification the solution to the problem to promote financial integration? What would you say, Nikos? You got to unmute yourself because otherwise we can't.
Indeed, branchification is an option in order to promote financial integration. It has been applied in some cases, and at least no large banking group that has opted for this solution. But there are some drawbacks in the case of branchification, mainly relating to how you can treat the case of resolution, because since the branch is not a legal entity, you cannot apply a resolution tool at that level, and any risks incurred by the branch will be transferred and should be covered by the parent entity. Also, there are some issues with governance arrangements and risk management process applied at the branch level compared to subsidiaries. And as a last point, I'm not sure that it's a preferable option from a business perspective, since profits arising from branches do not enjoy any preferential tax treatment that may apply in a jurisdiction other than that of the parent entities.
Yeah, thanks. Torsten Beck has a question, so he has the privilege of posing it live.
Oh, thank you. Yes, unfortunately, the panelists, we don't have access to the Q&A box. So, but thank you for this very interesting presentation. So, I have actually I have a couple of comments and questions. First, I kind of like what the discussant pointed out at the end, Nicola, that it would be interesting to find out which of these regulatory constraints that you pointed out are actually the binding one, or are all of them binding? Then, more generally, I mean, you mentioned this in your last slide, but there are regulatory barriers on the one side, but of course, there's also the fact that we have an incomplete banking union, right? So we have incomplete risk sharing. And you could see this actually coming up in March, April, when some of the Central Eastern European countries imposed dividend bans on the national level, with the argument that they are supporting their banking system indirectly through fiscal support measures, and they have to make sure that money doesn't flow out of the subsidiaries into the parent bank. And one of the reasons being there is a lack of European safety net if things really go wrong. So is that not something that, so again, the question, what is binding? Is it really the barriers, or is it actually the lack of financial safety net? And of course, in this context, also the relationship between national and central supervisors, so between the SSM and national supervisors. And then maybe as a final point, I mean, I think if I understand correctly, your discussion is really about the euro area. But what about the EU, meaning the non-euro EU countries, where not the same kind of rules apply, right? So the single point of entry is not necessarily there. There's a more difficult relationship between central and national supervisor, and there are other elements missing in the financial safety net. So I would very much like to see a reaction to that. Thank you. But a very interesting topic. Thank you.
One good thing about the Q&A function is that it requires people to be brief. But anyway, Nikos, you can pick what you want to answer.
Yes, as regards your last point, my paper covers the banking union mainly, since banks located in participating member states in the banking union are supervised by the ECB and the SRB-FBF resolution task. So we're referring to a single supervisor and single resolution authority. Of course, these arrangements could apply also in non-participating member states under the potential revision of the BRRD. But it seems to me very unlikely that there would be agreement between a supervisory authority, the ECB, and the supervisory authority from a non-participating member state in relation to waiver of capital liquidity waivers and internal MREL waivers as regards the SRB. So it's more likely to have these waivers only in the banking union. As regards your comment on what's most important regulatory barrier, I think that what is needed most is the removal of the option granted under Article 493 of the CRR, which provides states with the option to prohibit cross-border indirect exposures from the exposure limit and to supersede any decision the supervisory authority may have taken in that respect. Because even now, cross-border liquidity waivers are in place under the CRR, but cannot be applied in case that the host member state has applied this national option granted under the CRR. So if this option was removed, the cross-border liquidity waiver could be applied even under the current version.
Okay, let me thanks. Let me try to summarize a couple of questions that have been posed, which revolve around the question of integration is not a goal as such, but what we want to see is an efficient, profitable banking system within the common market. And now the question is, turns to be, can we somehow cope with the legacy problems that we have? Does your proposal do anything in order to increase the profitability of firms beyond just simply merging? And also, is that something that is an alternative to essentially cleaning up and consolidating, or what do you think?
I think that once we remove these regulatory barriers, banking groups operating in different jurisdictions or willing to operate in different jurisdictions would see an enhancement of their profitability to some degree. And this could be used by them in order to take action not to address potential NPLs problem with NPLs that will arise during this crisis through increase of provisions and some other measures that they could take, for instance, sale of NPLs, securitization of NPLs. So in that way, they could clean up their balances to some extent. And also, along with these actions, they could proceed to some further expansion of their operations, which could contribute to addressing the problem of overcapacity that exists in the banking system, in the Euro banking system, and has long-term effects on the sustainability of banks' business models, their profitability, and as a result of the financial situation.
Okay, so one remark from my side. I think one quite interesting case study that you should look at is, of course, the experience of Central European banks post-global financial crisis, because that sort of was already en miniature a very integrated banking system where these economies were essentially the hosts of foreign bank subsidiaries, and of course the experience there was very, very bad. And there you can learn a lot about what it takes essentially to build the trust in order to make a viable, mutually trusted system work. But that's just more of a remark, not so much a question. So I don't see any further questions here. So therefore, I have to thank Nikos and Nikola for this very stimulating panel discussion. And I will immediately turn over to the next panel, which consists of financial economists, which I'm very happy to welcome here. So we have Antonio Di Canio, who's a seconded national expert at the Single Resolution Board, who present joint work that he's done with Giuseppe Montesi on banking system in times of COVID-19, a reverse analysis on loss absorption capacity. And the discussion of that will be Torsten Beck, who we already saw in the Q&A. So immediately over to you, Antonio.
Thank you, Professor Tröger. I hope you can hear me and see me. Can you hear me? Professor
We can hear
Tröger?
you, we can see you. Now we're good.
Okay, thanks. Thanks, Professor Tröger. So just let me share the presentation with you. Okay, can you see the presentation? I hope yes. We would also thank all the members of the scientific committee and also Professor Beck for having accepted to be our discussant today, and of course all the colleagues in the SRB and Florence School of Business and Finance for having organized such a great event. Before starting seeing the slide, the usual disclaimer, of course we speak in our personal capacity, and the opinion expressed today are only ours and do not necessarily reflect the official view of our own institutions that are the SRB and Banca d'Italia for me, and the University of Siena for Professor Montesi. So in this slide, we have a short summary of what we have investigated in our paper. Basically, it could be summarized in 2 dimensions. In first one, for the banking systems of Italy, France, Germany, Spain, United Kingdom, and USA, we have calculated the maximum loss absorption capacity in 2007 and 2019, and also the capacity to expand the assets and so the lending to the economy according to 2 different regulatory thresholds: the minimum CET1 ratio, common equity tier 1 ratio, and the minimum common equity tier 1 ratio plus the buffers, the so-called MDA trigger. Then, in the second dimension, we have discussed about the relationship between profitability, market value, and regulation for banks. And we will see that regulation is not neutral to determine the profitability and the market value in the banking sector. Quickly, as for the data sets, we have analyzed the balance sheet of around 31 banks in 2007 and around 50 banks in 2019, covering a substantial part of each banking system in terms of total assets. For details, we have also an annex in the end of the presentation. Now, for the first dimension, we will see that there is a trade-off between the loss absorption capacity of the banking systems and their capacity to expand assets and provide the lending to the economy. Here, for each banking system, we system, we have a comparison between 2007, the first table, before the beginning of the great financial crisis, and 2019, before the outbreak of the COVID-19 pandemic. As we can see, all the minimum level of the CET1 ratio, Common Equity Tier 1 ratio, almost double, and loss absorption capacity too. In some cases, like France, has become 6 times. And this is evident if you look at the so-called break-even return on assets that we have calculated, and that is the return on assets that triggers the breaching of the different thresholds of capital requirement. Practically, we can say that is the maximum loss rate on total asset that each banking system can stand for before breaching the capital requirements. The conclusion is that all banking systems are now much safer than in 2007, much stronger, and just a couple of caveats about these slides. We have taken, of course, into account some of the capital relief measures put in place by the authorities after the outbreak of the pandemic, in particular, for example, the P2R rule introduced by the European Central Bank. And also we have taken into account that in 2007 there was a different regulation, also different banks in each country. In this slide, we can see that using the logic of the so-called Merton model, here we have simply calculated the distance for each banking system to breach the capital requirements, considering the historical volatility of the return on assets in each country since 1996. From this analysis, we can see that all countries are in a better position now, and in particular, Germany, France, and Italy. We can see this on the slide, on the graph here on the right. In this slide, we describe the capacity for each banking system to expand assets and consequently to provide new lending to the economy, even in a such difficult scenario. Of course, we have made 2 assumptions. The first one, less conservative, where the RWA density of the new assets increases by 50% in respect to the one in 2019. The second one, more conservative, where the RWA density of the new assets is equal to 100%. As we can see from these 2 graphs, in both cases, all the banking systems are able to expand their assets by at least 5%, without reaching any capital requirements. Only in the first one, they are able to expand assets by 10% without reaching the MDA trigger, except for the USA banking system. And finally, here on the bottom right, there is a graph with the calculation of the maximum implied credit loss rate in each country. And please take into account that since 1990, in our sample, the maximum credit historical loss rate has been between 1% and 4%. So now the situation, we can see that the situation is very comfortable from this point of view. Now we are in the second dimension. In this part of the presentation, we show what we have called the trilemma of the banking system, i.e. the impossibility, at least for the moment, to have at the same time, one, the banking system with high level of capital, the protection of public funds, and profitable and attractive banks to the investors. Actually, we will see that bank profitability has declined, while investor risk perception seems to have increased, despite the fact that banks today are significantly more capitalized and less fragile than they were before. In this slide, in order to show that a simplified discounted cash flow model is able to capture the implied equity value of a bank, we have estimated the price to book value ratio for all the listed banks in our sample, around 40 banks, and then we conducted an empirical analysis that supports the existence of a strong positive relationship between the implied price equity book value and the estimated one using the formula that we can see here. We carried out our analysis for 2 periods, one before the outbreak of the pandemic, and one just 10 days ago. In the paper, there is also an analysis for August. From these 2 graphs, we can see that the model fits very well the reality, and that after the pandemic, even more banks have now a market price to book value under 1. No? We can see that the blue area has been expanded in November. Only the American banks are more or less above, have a price book value above 1. In these slides and in the next 2, we can see the evolution for each country of the historical return on assets. It's the blue line. The implied return on assets to obtain a price to book value equal to 1 or 1.5 in a range of the cost of equity between 8% and 11%. And these are the red and green line. In the bottom part of the slide, we can see the evolution of the historical market price to book value. We can observe that in all countries, the implied return on assets required by investors increased by a lot soon after the great financial crisis due to the lowering of the leverage and the fact that the cost of debt and equity has not declined. On the contrary, they seem to have increased. We can notice that in most cases, even if the return on assets would come back to the golden age, would not be sufficient to have certain market valuations. No? And this is evident here. We have the implied return on assets for Germany in this moment, and we can see how distant is from the actual return on asset, and also from the return on assets that the German banking system had before the outbreak of the great financial crisis. And here we have France, and in the next slides we have Italy and Spain. Here the adjustments of the leverage levels was more contained than in France and Germany. And for the USA, the adjustments in leverage levels was quite significant, and so resulted in a significant increase in the implied return on assets. In these slides, we show the fact that the risk perception of the investors seems to have increased. The graph on the top of the screen shows the fact that bank credit spread proxied by the CDS increased significantly compared to the years before the great financial crisis. The maximum values of that time have become the minimum values of today. There is also this is also the opinion of Professor Duffy, for example. The graph on the bottom shows the fact that, except for UK, market betas tend to be higher now than in the years before 2008. This is in contrast to what suggested by several authors in the past, like Admati. They claim that higher levels of capitalization would have led to lower levels of profitability, but that the lowering of risk might have counterbalanced it. Actually, we agree with their view, but the reality until now seems to be different, as we have seen. Here we simply show graphically the relationship between the return on assets, the cost of equity, and the leverage in order to have certain market valuations, price to book value equal to 1 or equal to 1.5. The historical distribution of the return on assets since 1996 to give an idea on how could be sustainable certain level of return on assets required now by the market. And finally, from the graph on the bottom right, we can see that if the cost of equity does not adjust when the levels of capitalization increase, the return on assets should increase too. And how it could be increased or decreasing costs, for example, the cost of debt. But if we look at the paper quoted here by Gambacorta and Shin, they estimated that every 100 basis points of higher capital corresponds only to 4 basis points of reduction of cost of debt. Or bank would increase the interest rate on lending, with, of course, consequences on the real economy. And here we have come to the conclusions. Banking systems are now for sure in a better shape in respect to 2007. And this is, of course, a very good news, as we are in the middle of a pandemic crisis. And now, as also recalled this morning, banks could be part of the solution and not the problem. On the other hand, the capacity of banks to support the real economy and to be attractive to the investors depends also on the regulation that should somehow foster the environment in which banks compete. Finally, the real market situation in recent years shows that those market mechanisms that should act as compensation do not seem to work properly, and we refer to the fact that the perception of the bank risk has not declined among the investors. And I would stop here, and thank you for your attention.
Thank you, Antonio. Immediately over to Thorsten Beck of Cass Business School. Thorsten?
Sorry, but you,
okay. Yeah.
You have to, Antonio, you have to unshare, stop sharing, I think. Oh no, wait a moment. Can I share now? Oh, yeah, now I can share. Sorry, my mistake.
Yeah.
Okay. Thank you. So I hope you can see my screen. You can see,
yes,
hear me. Wonderful. Great. Good morning, good afternoon, everybody. Well, first of all, thank you for inviting me to discuss this paper. Very interesting. Very long title, as you can see. I will actually not so much discuss on the technical parts, but I will use this discussion to make some more general comments. But first, like we like to do it in among economists when we discuss papers, let me just briefly summarize what the authors do and what they find. So there are kind of 3 parts to this empirical exercise. The authors estimate the maximum capacity to absorb losses before reaching minimum capital requirements or the MDA triggers. The estimated capacity that these banks have to support the real economy, especially important during the current crisis, and the minimum level of profitability that they would need, the banks, so the minimum ROA, in order for investors to earn their cost, their return on equity, their cost of capital. It's a sample of banks in across these 5 countries, and the conclusions are basically that banks are currently much better capitalized than in 2008-9, reassuring. They are therefore also better able to support the economy, but they will be unlikely to earn their cost of capital. And so I'm kind of going to start from these findings to kind of make some more broader comments. And I'm kind of going to go back to what Antonio referred to as a trilemma, but I'm going to split it up since I guess I'm a two-handed economist. So I'm going to use two dilemmas here. The first one is going to be what I call a short-term trade-off between, on the one hand, between loss absorption, the ability of banks to absorb the losses that might come from the COVID loans, sorry, not COVID loans, from the COVID crisis. And on the other hand, our wish that the banking system supports the economy through additional lending. So now we've heard that the loss absorption capacity is much better now than in 2008-9. And it might actually be even more if we think that a lot of these potential COVID losses are or will be covered by government guarantees. On the other hand, the COVID losses are not really apparent yet. We know that the loan loss provisions have been kind of put aside. And we don't really, as far as I understand, supervisors don't really expect these bank losses to show up until the second half of 2021 and maybe to peak in 2022. So that's on the loss side. On the lending side, I mean, one of the reasons for this capital relief that many supervisors in Europe implemented in the beginning of the crisis was to have exactly this higher lending. But of course, higher lending at the same time reduces loss absorptions, again, with the caveat that I mentioned before, and can push banks, of course, closer to the MDA trigger, which might them also then more reluctant to actually lend more. Now, of course, we had the dividend ban in place in Europe. But of course, banks might just waiting for this to be taken off, and so they might want to not lend more in order to avoid not being able to pay out dividends once they're allowed to do. So this is a bit of a what I call pushing on a string. So this, and I guess, shows also the limitation of regulatory measure to encourage lending. So we kind of, there seems to be a consensus that all of these macroprudential measures can help kind of limit aggressive overlending. But on the other hand, can it really help induce more lending in a crisis situation? That seems kind of questionable. Now we can, of course, I mean, one solution, and well, it's not really a solution, the solution in quotation marks. I mean, what we've been observing a little bit with these, all of these fiscal support measures and the guarantee schemes is that banks are almost turning into kind of utilities that simply pass on government funds or government guaranteed funds to an economy that is in desperate need. Now, again, this would be a short-term crisis measure, but of course, in the long run, we need the banks to really fulfill their function of reallocating capital to their ex-ante highest return. So how can we actually get back to a market-based or market-funded banking system? So that's the first trade-off. The second trade-off that Antonio referred to is the between the financial stability on the one hand and earning the cost of capital on the other hand. So we reduce the leverage, and here I have the very simple formula. There's of course much more to it. If you reduce leverage, we have to increase return on assets to get to the same return on equity. Now, of course, there is an offsetting effect, as mentioned Antonio, that if you have actually higher capital buffers, then there's a lower risk of failure. However, this might not have been taken into account before 2008 because everybody expected to be bailed out anyway. So actually, ROA might not come down because we have now bail-in expectations rather than bail-out expectations as before, which of course can also tell us that maybe before the crisis, as many would argue, including myself, there was maybe too much banking. The financial sector was simply too big because of the bailout expectations. Now, if we still think that the ROA is too low, then how do we increase the ROA? Well, part of the low ROA is of course monetary policy, and I don't think anybody seriously thinks that the interest rates are going to increase anytime soon. I mean, we've gone from low for long to lower for longer. Shrinking banking system. Actually, I saw something in the Q&A box on that. Yes, exit of weak banks, maybe also merger, maybe therefore achieving cost efficiency. diversification of income streams. So these are kind of questions I would be interested in. How can we actually get to a higher ROA? I mean, so shrinking is definitely part of it. Maybe also, again, coming back to the theme of the previous paper, cross-border mergers might help, but do not necessarily. So if I want to combine these short and long-term perspectives, and coming back to the themes I mentioned earlier, so one thing we definitely need is this exit strategy from public support, capital relief, towards loss recognition and the reallocation, to kind of go back from the kind of emergency mode to regular programming, kind of a market-based, market-funded banking system. How to go about this? I think the only way to do it is in a coordinated way, ideally actually on the European level. In the longer term, how can we make the banking sector more attractive? There are some who say, well, just let them allow to pay dividends again, as if there were no tomorrow, as if there were no losses to come up. Well, maybe it's more about, and I doubt very much that just by allowing banks to pay dividends again, they would become more attractive for investors. I think there are some more underlying symptoms that have to be addressed. And here's my last slide, in case Tobias gets nervous. Crises are opportunities. I think we're much better prepared in this crisis than we were in previous crises. The initial response has been nothing short of amazing by supervisors, very swift, very decisive. And this crisis has also been already used for good opportunities, such as the European Recovery Fund. So I think something similar for the banking system should be hopefully on the cards. I mean, again, picking up on a couple of themes that we discussed earlier today, kind of moving towards a cross-border process of consolidation and restructuring to kind of shrink the banking system to its optimal size. Yes, there is the concern of too big to fail, but of course it would be then on the European level. We would take out the national political connection that hasn't been mentioned today, but I think local politics, national politics is still far too influential in European banking. So I think that that might be a way. Not just trying to address the upcoming fragility in banking, but actually to use the chance to really come to move towards a sustainable and also maybe more profitable European banking system. As I mentioned earlier, I think this also requires the completion of the banking union. And of course, the development of European capital markets can also help. I mean, just to mention, for example, the market for bad assets, for non-performing loans requires a liquid capital market. Now, the good news is that unlike the previous episodes of systemic banking fragility or banking crisis, this time there's certainly not really a surprise element in there. We kind of know what to expect. I mean, I'm not trying to predict the banking crisis, and anybody can predict one, but we know there will be fragility coming in half a year or a little bit later. So kind of preparing now, I think, would be very beneficial. Thank you very much.
Thank you, Professor Beck.
I'm sorry, Antonio. Just
sorry.
No problem. Just a quick reaction. Thanks, Torsten. Thanks a lot. Very insightful. Antonio, do you have a quick reaction or?
Yes, sure. No, thank you, Professor Beck. We agree with your analysis. I agree personally with your analysis. What we have tried to do in the paper was to show the fact that now banking system in each country, at least for the countries that we have taken into consideration, are much more safer than in 2007 before the outbreak of the great financial crisis. And we simply have calculated how much losses each banking system can stand for before breaching the minimum common equity Tier 1 ratio without considering the buffer, and also the other thresholds, that is the MDA trigger. And in particular, we have considered the MDA trigger when we have calculated the capacity for banks to expand assets, because of course we agree on the fact that banks would be reluctant to go under the MDA trigger to support the economy. But even in this case, with the current capital levels that we have in our banking system, banks can heavily support the economy, expanding the assets without breaching the MDA trigger, for example, and still have a lot of loss absorption capacity. Of course, we have not considered the guarantees given by the different states. Personally, I think that in this moment, states were also able to provide this guarantee on the new credit because banking systems are now safer than in the past. So this is also an assurance for the governments. But I agree with Professor Beck that in the coming years we will see the effect of this of the pandemic on our real economy and banking system. And of course, this would also depend from how much the different countries will recover from the pandemic. On the other side, we have the fact that banks should be attractive to investors because also supervisors regulations pushed the banking system to rely on the market. So it should be important for banks to be attractive to investors and also to be profitable to support a certain level of growth in the economy. What we have seen is that some market mechanisms do not seem to work until now. So the cost of equity has not decreased, the cost of debt neither, also maybe because there is a new regulation on this side of liabilities. And how to improve the return on assets. Return on assets should be improved by a lot to have now at least market valuation that could be more or less attractive to investors. As correctly pointed out by Professor Beck, yes, we can go for more efficiency, but we think that in some way the markets should be convinced that now banks are safer, so that also the cost of capital and cost of debt would decrease. Otherwise, banks would be forced to increase the lending, the interest rate on lending, and of course with the consequences on the real economy.
So let me pick this up, because one way of reading your data could also be that finding that banks are perceived as riskier. So investing in bank capital, loss absorbing capital instruments is perceived riskier by investors, is essentially that all the reforms that we've taken post the global financial crisis have not fully substituted the government guarantee that existed, the implicit government guarantee that existed before 2007. And if that's the case, then I would probably interpret your data the other way around and say, okay, look, banks are indeed still riskier because all the regulatory measures are not essentially substituting fully the implicit government guarantee that existed or arguably existed pre-GFC. If that's the case, we're not yet there. So is that totally out of the picture, or what do you think?
No, actually, thank you for the question. But actually, we think that for sure, new regulation made the banking system safer. But of course, without also the fact that there are two sides of the same coin. On one end, we have the cost of equity that does not seem have decreased, also with much more level of capital. On the other end, we have also the cost of debt that is in some way increased, and we have seen this from the CDS. But this could be explained, as suggested by Professor Duffy, by the fact that new regulation on bail-in would have shifted part of the cost from the state to the investors. So our thought is that there would be still a little bit more of time for investors to understand the fact that now banking systems are anyway safer than in 2007.
Okay, thanks. So let me pick up one.
Sorry, can I just come in very briefly? So I think.
Sure.
I just have a very quick comment on that, because so I don't think the purpose of the regulatory reform is not to make banks safer for equity investors. The purpose of the regulatory reform was and is to make banks safer for society. And that, of course, doesn't necessarily show up in these in the cost of capital for equity investors. So to really test this hypothesis, what you would have to do, and some people have done this, is to compare debt instruments that are subject to the bail-in and debt instruments that are not subject to the bail-in. And there you can see that after the introduction of the bail-in and or news that kind of point to the way that there will be a bail-in imposed, that actually the cost for bail-level debt goes up compared to non-bail-level debt. So I think that's why you would actually find this.
Okay.
Yes.
Yeah, I'm sorry.
No, we agree with you, Professor Beck, but the fact is that if banks will not be profitable, they would not also be able to provide lending to the economy. So this is important also. So we agree with you that the purpose of the regulation should not be to make banks profitable, but safer. But on the other hand, for banks to sustain certain level of capitalization should earn some level of profitability. Otherwise, there would always be the need to recapitalize the banking system.
I think we need to close here, unfortunately, but we are running out of time, and it already suggests that we're 3 minutes over time. So I have to thank Antonio and Torsten for this lively session. And I guess also all of the audience who will now have the opportunity to enjoy the concluding remarks, but over to Pierre to announce our distinguished speaker for that purpose. Thanks a lot.
Thank you.
Thank you. Bye.
Thank you, Tobias, Nikos, Antonio, and Torsten. Very exciting discussion. Indeed, time for concluding remarks. They will be delivered by Bosjan Jaspek, who joined the SRB in 2018 and where he's currently a board member and the director of resolution planning and decisions. Bosjan, you have a background in economics. You worked in several international institutional organizations before, EBRD, World Bank, IMF, BIS, and many others at the national level. The floor is yours. I'd like just to remind you that we have up to 10 minutes. Thank you.
Thank you, Pierre. I hope you hear me. Thank you very much for giving me this opportunity to round out this very, very interesting discussions that we all had an opportunity to listen throughout this morning. Before making my final remarks, I would again congratulate us, the Florence School of Banking and Finance and SRB for this joint effort in organizing this conference, which is to the point in respect to time. We live in difficult times, and of course to the content and then substance that was so nicely laid out in today's discussions. So the thing that I wanted to allude to in my final remarks pretty much echoes these efforts and initiatives, and I'm really glad that if my counting is correct, that we had 19 research papers submitted to this event, and yes, it was short timing to discuss just few of them that limit our choices in this respect, but all submissions were very valuable, and for us at the SRB, it is very important that we reach out in the events like this to also hear and see other views, and with one and only purpose to strengthen the resolvability of the banks that we are dealing. So all the future policy decisions and potential future revisions to the resolution frameworks are in this respect more warranted and supported by discussions like we had this morning. So the interesting, and then I'll go through all three panels and then also keynotes remarks that were given. As regards the discussion on a proposed temporary amended version of the precautionary capitalization under the single resolution mechanism regulation and involving the European stability mechanism, there were really some interesting points raised there. Of course, should we be trying to amend the precautionary capitalization to facilitate public intervention to support the economy is a big question. And then there are different views there. But even if we sort out those temporary objectives that we were trying to implement here, it is really a question how to operationalize them and how to implement them. For me, the biggest question there is really the heterogeneity of different approaches that banking union members and in some one panel there was also a question what to do with all the European Union members that are not part of the banking union, how to approach the things there. So the thing is how to implement, how to respect the level playing field in trying to make some temporary changes or amendments to the framework really doable and executable in a way that would not distort the resolution mechanism framework. The other thing is, of course, would it become an impediment in achieving the banking union's objective to make banks more visible without the taxpayers' money? I mean, giving the proposals and particularly in the sphere of precautionary capitalization seems to defy the main principle or the main objective of having resolution framework to avoid the use of taxpayers' money. But yes, the circumstances are exceptional, and it is of course for us to dig deeper into those questions and then try to figure out what works and then what doesn't. And then here on all panels we were trying to make some reference to the financial crisis of 2008, and then we're constantly benchmarking ourselves to what we observed in 2008. So in a way that also prevents us to reinvent the wheel again and again, and then maybe we could use some lessons learned from that period of time, which is not so distant. I mean, and that was particularly true when we were discussing some of the legacy issues that were still not resolved today. I mean, we still have in terms of NPLs. For me, the biggest discussion is a stock of NPLs that is a legacy from before, and the newly generated NPLs that are a consequence or the result of the current crisis. And of course, in being resolution being part of the not only of economic or financial issues, we have to admit that the resolution is also a political issue. So taking some amendments, temporary amendments, might become a serious political issue at some point. And then we know that some temporary measures that were introduced in the past then became the standard tools or framework in this respect. So one can argue that more temporary emergency measures we bring in, the more time we tend to spend on deciding how to roll them back at some point. And there is always this questions. Okay, we introduce them, but what is the exit strategy? And the exit strategy seems not to appear in some of these discussions. Of course, it is not to say that we should not have any measures. And then one should only introduce such temporarity of emergency measures when we have good data on which to base such decisions. And I'm coming back to the point that at least 19 banking union members have introduced different national measures in this respect. Today we are dealing with different guarantee schemes, different maturities of moratoriums. This should be somehow clarified now at the end of the year, when most banks will have to go into the auditing processes of their balance sheets, and then there is always already a problem on how the external auditors will take into account those temporary measures. I mean, it seems that in some countries, those temporary measures are being pushed off the balance sheet and then below the balance sheet issues. And this is something that, again, causes a problem in terms of level playing field in this respect, on top of still having very unsynchronized insolvency procedures in all these countries. So that, for me, raises more concerns than definite answers and conclusions. Of course, if it doesn't jeopardize our objective of burying the bailout and ending the too big to fail problem that caused so much economic and social harm at the end of the financial crisis, then you know that the European Systemic Risk Board is heavily involved into this analysis of too big to fail issue there. So, a too big to fail issue also relates to something that is somehow constantly overlooked, at least in terms of talking about the European banking system, namely the cross-border mergers and acquisitions. We do tend to talk about European banking system, while in reality we have the compendium of 19 national banking systems, and every single announced or alleged merger and acquisitions are now taking place only within the national borders. The only discussion is is very easily swept from the table by something that was also mentioned in one of the panel, namely there are so many regulatory obstacles in making the cross-border mergers more feasible and more welcome. So the other thing is that, of course, in this respect, then making amendments to the resolution framework always touches a very sensitive area, namely what are the viable and feasible business models for the banks that we are talking about. Because by setting up the regulation framework, we are somehow implicitly also raising the question of viable business models. We know, and then there's something that we are constantly trying to avoid, and this is the elephant in the room, namely in European banking sector, we do face the overbanked sector, and that is something that again defies all the textbooks that are usually introducing the topics on banking by claiming that banking is pretty much the question of economies of scale, economies of scope, and this is something that I fear by introducing the temporary measures on one hand, not pushing for further synchronization of insolvency regimes across banking union member countries, and particularly not finishing the necessary steps to complete the banking union in this respect, are bringing us back to dealing with the national more than supranational, and in this case European solutions or ways out of the crisis. I really like I think Torsten said crises are opportunities, and then crises are opportunities in this respect also to deal with the bigger picture, and the bigger picture there really is acknowledgement that we should also be a bit more comfortable with potential exit from the market in this respect. We are trying now to save every single bank in this respect, and then for me that might somehow blur the potential benefits of using the crisis to further strengthen the European banking system. And second, of course, we would like to compare ourselves to and then make something that resembles the European FDIC in this respect. But for that, we need a serious backstop. I mean, when talking about the FDIC, we know that the US Treasury is there to provide the backstop. We don't have this. The closest we come in this respect to the backstop is something that is today encompassing in the European systemic mechanism, but ESM is something that is half baked, half not fully yet established as something that would provide the backstop for potential setup of European FDIC. And there again, for setting up something as a European FDIC, we would need to have more centralized approach, and then we are squaring the circle again and coming back to the beginning. And these are the questions that, of course, are overarching, are something that make the bits and pieces that we heard today as important part that need to be put together in this very complex set of puzzles. And then for that reasons, every single point needs to be very clear in initiative of why we are doing something, what we are doing. And I think for that reason, today's conference really made, at least in my view, substantial contributions in shedding lights on all these different pieces that really make the understanding of what we are dealing in a banking union to maybe better understanding. But we would still need to connect those dots in a way that that would, at least in my view, pronounce the adjective European better than making just European as a compendium of 19 and now very soon 21 banking union members. And in this respect, making the resolution really a tool that we are not afraid of, and not afraid of also on pointing out that for some entities in European banking system, the only way is to exit. And this is something that, of course, on European level makes discussion a bit easier than on the national level. I usually tend to say that resolution is always best understood when it happens on somebody else's backyard, but when it gets to your own backyard, then you tend to go into the very defensive position and then make all means and tools available to preserve the status quo. And in this respect, I guess we might miss opportunity to take the crisis as a vehicle to further strengthen the resolution framework and make the European banking system more competitive and European in the true sense of the meaning and the word. With that, I would thank you all for very interesting discussions, and I just hope that those discussions, in particular the conclusions, would be carried over to next discussions that would need to clarify the picture and understanding of the European resolution framework in the true sense of the word. Thank you.
Thank you, Bojan. And I think that also your concluding remarks will help to direct or flag some issues for future research. I'd like to thank all the speakers today, all the organizers again, and most importantly, all the participants. I think it's been a great and stimulating debate today and very interesting presentation of papers. And I hope there will be other occasions in the future to interact and catch up. Thank you all.